So good morning, everyone. So last time we were speaking about different types of pooled funds, right? And we spoke about private equity. We had previously spoken about mutual funds, and what we have remaining for us today is hedge funds. So if you remember what we were talking about, we said that when you think about these three types of funds, mutual funds, private equity, and hedge funds, all three of these types of funds are pooled funds, right? You have multiple people investing in these funds, all three, which is why I wanted to do it with the mutual fund. Otherwise, hedge funds and private equity usually fall under alternative investments. So it will usually come under alternative investment asset classes, but I generally take it under the mutual fund topic because they're the same concept of pooled funds, right? So if you think about mutual funds or unit trust funds versus private equity versus what we are doing today, hedge funds. Mutual funds, you have multiple people investing in these funds, right? These are true retail products. They are true retail products, meaning they are open with very little investment value. They are open to any type of investor, retail investors, right? So for most funds, other than a few funds who might say that they have a higher watermark in terms of the retail investors that invest in the fund, generally with 5,000 rupees, you can start investing in a mutual fund. Okay. So other than a few fund management companies who might, as a strategy, use higher minimum investment sizes, with 5,000 rupees, you can start investing in a mutual fund. So you can see that mutual funds are for everybody. And because they are for everybody, they are highly regulated. They're highly regulated. Because you're looking at retail investors and you want to safeguard the interest of the retail investors. So, excuse me. And they are relatively low risk. Why I say relatively low risk is they are much lower risk than private equity or hedge funds. But within the investment class, you can have low risk to high risk, right? For example, if you think about mutual funds investing in government securities, money market will be low risk, very low risk, versus mutual funds investing in share market investments, right? Even within government securities, if it's money market versus a bond fund, you can see that the risk differs. And the risk differing means that there is possibility that you can even lose money in this process. So because you're investing in the share market, for example, when you're investing in the share market, there are possibilities you can even lose capital. Same way if you're investing in a bond fund. If you're investing in money market funds, lower risk, right? So within that spectrum, you can take on low risk or high risk. But compared to private equity and hedge funds, mutual funds are generally considered very low risk investment vehicles, right? Versus when you talk about private equity or hedge funds are higher risk investment vehicles, which is why they usually come under the alternative investments category. Alternative investments category. So we spoke about private equity last time. And in private equity, we said that you're now not listing in public equity. You're investing in companies on a private basis. So you're still investing in shares of a company in private equity, right? But now you're investing in mostly private companies to help it grow and expand. You're investing outside of the realm of the share market. Of course, we spoke and we saw a few examples. For example, TPG investing in Union Bank. So we've seen private equity move away from that original definition of theirs. But still, if you think about for a fund in a developed country coming to a country like Sri Lanka and investing in a illiquid stock market, they would still consider a higher risk investment because it would take time, and it actually did take time for them to move out of their investment, right? So, which is why they still expand that category. It is not like you're investing in a company that is in a highly liquid share market country, right? But so when you talk about private equity, you're talking about investing in companies, taking ownership positions in companies where you are where you become a shareholder, mostly in private companies, to help them grow. So within private equity, we spoke about the fact that you have multiple branches of private equity, but we spoke about two: venture capital and private equity buyouts, right? And in venture capital, we said that this is where you're giving money for companies to grow, seed stage, like at very early, smaller companies who are just starting their development, sometimes at the very early stages, having ideas, and they are looking to get funding, and sometimes banks might not give them funding, might not want to take that type of risk, or even if they do want to, this is another avenue for them to look at fundraising, right? So alternative finances. So what happens in a private equity fund? You have all these, again, multiple investors pooling together to go and invest in. Now the fund manager will take that money and now invest in private companies, right? But here, when you're looking at alternative investors pooling their money together and investing, you will have two different types of investors. You will have what we call the general partner, who is the sponsor of the fund, and the limited partners, who are like the other investors into the fund. The thing about limited partners are the difference between limited partners and the investors in mutual funds is that limited partners in this case would still be investors with a higher amount of money to spend, who we call accredited investors. Accredited investors, right? So they have minimum criteria in terms of the definition of who is an accredited investor. If you're an accredited investor in the US, they have definitions in terms of your minimum salary that you have to earn. You have to be able to make an annual salary of $200,000, net assets of, I think, 1 million, right? So all of this will be taken into account to figure out whether you're an accredited investor or not. So you're looking at high net worth individuals, asking them to come and invest in private equity investments, because private equity investments are more risky, higher risk than mutual funds. Right? Higher risk than mutual funds. That's why you ask for accredited investors, right? Because of the higher risk component that you're taking. Otherwise, you can ask any investor to come and invest. Private equity returns have been pretty good historically, but you are taking a very high risk, meaning sometimes the returns are very good and sometimes you can lose a lot of your money, okay? Which is why it is not open to retail investors. The GP or the sponsor of the fund will also invest money. Your LPs or limited partners will also invest money, and you take this money and then you find various investments to make in the private equity space. With the GP, you have a fund manager or a fund management company who will be the ones who are identifying which companies to make investments in. And you can understand, because these are private companies, they're long-term holds, right? They're long-term holds. You have to hold them for periods of maybe even 5 years, 10 years, sometimes 2 years, but highly unlikely to get your money back. And how do you get your money back? By being able to exit the company. Why is that such a big task? Because unlike in a mutual fund, where you're investing in the share market, if you're investing in the share market fund, you can just go to the stock exchange and try to sell it off, right? But in a private equity fund, there is no stock exchange. It's private. So you have to find a way of exiting your investment, which could be looking at an IPO, which could be selling it to some other investor, right? So you have to look at different avenues on how you can exit this investment, and only upon exit will all these LPs be, and as well as the GP who has put money, be able to realize their investments. Mutual funds fees are lower because the type of activity, the type of sophistication that is required for the analysis sometimes is not as high as private equity. Because in mutual funds, yes, you analyze in the stock market, but they're listed companies. A lot of the information is available in the public space. Stock exchange requires annual reports to be published, right? When you come into the market with an IPO, there's a lot of information that's been given out about the company. Some companies in the bigger companies do investor forums. So there are multiple sources of information that is out there for you. Versus when you go into private small companies and give money, there's literally no information that's available to you. You have to use a lot of proxies. You have to use a lot of savvy to be able to gather up and figure out what are the valuations for these companies. So there's a lot more management involved in these valuations and in terms of figuring out where to invest, how to exit, right? It's a lot more effort involved, which is why private equity fund fees are quite high, generally in the form of 2% management fees and 20% profit share, right? So if at exit you make a profit over and above certain limits, usually 20% of that profit is shared. 20% of the profit belongs to the GP, and only 80% flows back to the LPs, who will then have to share it proportionately among themselves. Okay, so that's a private equity structure. Versus now we come to hedge funds, hedge fund structures. So in a hedge fund, we're looking at essentially again a pooled fund. Okay. Again a pooled fund. Again, most hedge fund structures goes as LP-GP structures. Right. Usually management fees are still 2 and 20. LPs still are accredited investors. Right? So very similar. You can see that's why they are under alternative investments. Very similar in terms of the way the two funds are structured, not the investments, but the way the two funds are structured are pretty similar, right? But in hedge funds, you're looking at essentially taking on and investing in much higher risk instruments, trying to exploit certain anomalies there are in the market to make gains, by taking on higher risk. So the term hedge generally means lowering of risk, right? The term hedge means lowering of risk. So hedge funds do, most hedge funds, and the original hedge funds definitely started off this venture just like private equity. Now you've seen in my example how Union Bank was invested to by a private equity company, and we say, okay, that's not private, right? But if you look at, for example, hedge funds, also the structure started off as a way you try to hedge two instruments. So hedging is what the purpose of hedging is, to try to bring your risk down. So you do a lot of the time in most hedge funds, you do try to bring the risk down in a certain component, but there are multiple different layers of risk, right? So while you're bringing your risk down in a certain component, doesn't mean that you're eliminating risk, because you still have other risks involved. And these risks in hedge funds can be quite high. So just to put it in context, it's something like, for example, not hedge funds, but the concept of this risk that I'm talking about. It's something like, for example, when you talk about government securities, you say it's risk-free. But really it's not. Not because there is default risk. Not because we went through a debt restructuring, right? Government securities are risk-free. Technically, government securities are risk-free. What risk-free? Default risk-free. We don't say government securities are default risk-free. We just say government securities are risk-free. Government securities, though, are default risk-free, but they have interest rate risk. They have reinvestment risk, inflation risk. There are so many other risks that government securities also have. interest rate risk being one of the highest, right? The biggest in the spectrum that they have. So in interest rate risk, you saw last 1.5, 2 years ago, when interest rates shot up, government securities lost value of nearly by 50%. Okay, prices came down nearly by 50% when interest rates shot up to like these 20, 30% levels. That's interest rate risk. Just because you have a government security doesn't mean that you wouldn't lose money if you tried to sell it. Just like that, hedge funds also try to avoid risk in certain aspects, but they do still carry risk. Okay, excuse me for a minute. Just give me 1 second. Sorry, guys. So, as I was saying, hedge funds still do carry risk. And this risk, though, although they try to eliminate certain types of risk, most of the time what we call market risk or beta risk, right? They eliminate certain types of risk, but they carry other types of risk, which actually makes them extremely risky vehicles to invest in, which is why they, again, are limited in the scope of type of investors that can invest with them, usually accredited investors, right? And minimum investment sizes in mutual funds are very small, like in Sri Lanka, 5,000 rupees, but in hedge funds and in private equity, it would be $10,000, $50,000, $100,000. $10,000 is actually quite low, on the lower side. $50,000 to $100,000 might be typically what you would see in a private equity hedge fund minimum investment. Okay. Sometimes even $1 million. Okay. Any questions here so far?
Miss, aren't mutual funds also classified as alternatives?
Mutual funds are not mutual funds are not classified as technically alternatives. I'm sure there are certain classifications or certain places you will see that it is classified as alternative investments. I have also seen it from time to time, but technically not. They still fall under that traditional investment realm because the underlying is still shares and still bonds. So all you're doing is pooling the money together. That's it. So this is what we're talking about, right? So there are alternative investment pooled funds, which try to use different strategies. Sorry. So here, what do hedge funds do by pooling together all this money? The fund managers of a hedge fund with the GP, the fund managers of a hedge fund, try to now go and take this money and invest it in sometimes the traditional markets like the stock market or um, bond markets, but most of the time, even though they are investing in the share markets and bond markets, there are different strategies that are employed. A lot of the now in mutual funds typically are not allowed to what we call short. Right, shorting is not allowed in mutual funds. Leveraging is not allowed in mutual funds. Right. What do you mean by shorting of an investment? It's selling an investment before you have it. Okay, so we'll talk about shorting in detail next week when we are like finishing up the investment banking section. But shorting is essentially when we say we are going long, that means we are buying something. When we say we are going long, that means we are buying something. When we say we are going short, we are selling something. So typically selling something we don't have. That's the typical terminology. Short can be used just for the fact that I'm shorting a stock can be used just for the fact to say that I'm selling the stock. But typically it means that I'm selling the stock that I don't have. How do I sell a stock I don't have? I sell a stock I don't have by borrowing that stock. I borrow the stock and sell it, right? But we'll talk about shorting when we come to the section next week, right? Um, Going long is typically buying shares. Now, borrowing and buying or borrowing and selling, these are concepts of what we call leverage. Okay. Margin, leverage. Mutual funds are not allowed to leverage. They cannot borrow money and invest more money in the share market because leveraging entails high risk. Leveraging, if you borrow money, now, for example, I, as an investor inside the mutual fund, has given, let's say, 100,000 rupees. You have given 1,000,000 rupees. And the mutual fund is now 200 million. That's how much the mutual fund has to invest in the share market. If the mutual fund is 1 billion, that's how much the mutual fund has to invest in the share market, right? Not they can't then say, okay, I have 1 billion rupees with me. Let me borrow another 500 million against this 1 billion rupees. And I go and invest 1.5 billion rupees in the share market because I'm so bullish. I think the share market is going to do so well. So I put more money into it. Can't do. It's a really good strategy if you think the markets are going to do well. But if your call is wrong, you can lose a lot of money with leverage. So therefore, mutual funds are not allowed to leverage. It's undue risk for retail investors, right? Rationale is. And same way, they're not allowed to short. Hedge funds, most of their hedge strategies are shorting anyway, right? Part of their hedge strategies is shorting. So shorting is very prevalent in hedge funds. Leveraging is very prevalent in hedge funds. So therefore, these funds are very high risk funds. With shorting and leveraging, you can lose a lot of money if your calls go wrong. And every single call is not going to go right. Okay. So, which is why, again, what you will see is even though they might sometimes be investing in traditional instruments, still there will be shorting, there will be leveraging, which is not allowed in mutual funds, and they are very high risk strategies. So what do hedge funds do? They don't just go and invest in the market or buy bonds or whatever. They will look at different strategies, executing different strategies in different ways to take advantage of market volatility, different anomalies in the market, right? Anomalies, more than volatility, different anomalies in the market. What do I mean by anomalies in the market? Undervalued, overvalued shares. They'll look for what we call alpha, right? So they'll search for shares that are undervalued, search for shares that are overvalued, or bonds that are undervalued, bonds that are overvalued. And they will buy bonds that are undervalued and sell bonds that are overvalued, for example, trying to hedge their risk, okay, bonds or shares or whatever you're talking about, and try to execute strategies that will give them very high returns. But strategies that can give them very high returns also carry very high risk, meaning if their strategy goes wrong, you can lose a lot of money. Which is why, again, there are safeguards against the types of investors hedge funds can invest in. And this is the way hedge funds are, because hedge funds are not regulated. right? To the extent that in the US, hedge funds are required to be registered with the SEC, right? Required to be registered. But hedge fund as an industry has for the longest time fought very hard to keep themselves out of the SEC's purview. Because the rationale is if you come under the SEC's purview, SEC has a mandate to protect the interest of investors, right? And here investors are coming to take high risk. They come with their eyes open, understanding that they are taking a high risk. You hope that they come with the eyes open, understanding that they want to take high risk, right? So if you try to then SEC puts in different safeguards, hedge funds can't execute their strategy. So a lot of the time, hedge funds are not regulated in a lot of markets. In the US, hedge funds are required to be registered. They can't sell though to retail investors. They have minimum limits in terms of how much minimum investment size. It has to be accredited investors. All of these are there. That's the extent of the regulation that there will be in terms of who is investing, what type of investor, not so much the investments. Right? Versus in a mutual fund, you see that SEC highly regulates it. Not that SEC takes responsibility, but SEC puts a lot of safeguards to make sure that the fund managers cannot take undue risk, right? There are still ways that mutual funds there are still loopholes that can probably be there, but they put a lot of safeguards to make sure that mutual fund managers cannot take undue risk. Like, for example, they say not more than 15% in one company, not more than 25% in one group. So they try to make sure that the fund is diversified, no shorting, no leverage, right? So all of these different things are there to reduce the risk of mutual funds to safeguard the interest of smaller investors. So hedge funds, what do? They take this money and they want to execute strategies where they have long-term view on certain events happening. And based on that view, they'll take that money, invest, and hope that their view comes true. Hope means not like pray, obviously, right? You're taking a calculated strategy. And sometimes that strategy can go right. Sometimes it can fail. Yeah. So we'll talk about an example of that as well. A very famous example of how strategies have gone right and how they have failed as well. So, yeah. So that's about hedge funds. So, which is why what we say is they're aggressively managed. They use derivatives like call options, put options, which mutual funds cannot. They leverage. They can invest in domestic markets. Obviously, in Sri Lanka, we can't invest in international markets. We have certain restrictions. So, which is why commonly they are not subject to too many SEC regulations. Right. So, the first modern type hedge funds, because hedge funds have been there in some form or the other, because they're simply funds, right? And simply people taking money and making investments on behalf of other people. So, in some format or the other, they've been there for the longest time, right? Dating back to ancient ages. But the modern form of hedge funds is first attributed to this person called Alfred Jones. In 1949, he actually created a partnership. So he created partnership with a set of investors where in this partnership, he essentially took money from different people, from different investors. So think of this like a very informal arrangement where he's taking money from different people and he's investing on their behalf because he's a very savvy investor, right? So it was not like a formalized structure, the first one, but ultimately that's how the formalized structure began to develop. So he took the money and he executed this strategy. It's what we call a long short strategy, right? So what he did was because he's attributed to be a very good investor. He identified certain shares that he thought were undervalued and he purchased them. And he identified certain shares that he thought were overvalued and he sold them, shorted them, right? Now remember, shorting means selling shares you don't have. So what he did was essentially he identified a bunch of shares that he thought were overvalued. He sold them and then used that money plus the investors' money to go and buy shares that he thought was undervalued in the share market. So he committed part of his own money as well for this process, just like a general partner would. General partners, remember, also commit part of their own money. So he hedged his position. Why did he hedge his position? Because he went both, he bought shares and he shorted shares, sold shares, right? So on a net basis, he's gone long and he's gone short. He has hedged his risk because the undervalued shares, he's expecting the prices to go up, and the overvalued shares, he's expecting the prices to come down. So in a shorting strategy, you sell shares you don't have. Let's say, for example, right now the share is 100 rupees. You think the share is overvalued. You sell it today. You don't have the share. You borrow the share from somebody and you sell it today, hoping that the share price will come down. Okay. And when the share price comes down, you actually buy it in the share market. But this is not your share. You borrowed shares and sold it. So you return the shares back to the original owner. Right. You return the shares that you bought back to the original owner who had originally purchased it. So you've sold a set of shares at 100. You repurchase it back at 50, return it back to the original owner. But on your books, okay, just to make my life easy, I'll say you sold 1,000,000 shares and you buy back and give the owner back 1,000,000 shares. In your book, you made 50 million profits, right? Without spending any money, because you didn't have to buy 50 million shares and wait for the market to go up, right? And then sell it at 100. That was not what happened. You sold something that you thought was going to come down in price, waited for the price to come down and bought it back and made a profit in between. That's shorting. So what are you trying to do here? Buy shares you think will go up because they are undervalued. Sell shares you think will come down because they are overvalued. And you wait for the strategy to realize. For other people to also realize that these shares are undervalued so that they will start buying and the share prices will go up. And to realize that these shares are overvalued so that they will start selling and the prices will come down. So you need a little bit more time to realize these strategies, which is why in hedge funds, again, hedge funds are long-term holds. Not as long as private equity. Private equity, remember we said, sometimes can be in the range of 5 to 10 years, depending on the type of fund you're entering, right? Your money you can't get back for another 5 to 10 years. Sometimes 3 years if you're lucky, right? Mutual funds, on a daily basis, liquidity is provided. Daily liquidity is provided. Every day, today you can put money, tomorrow if you want to, you can take it out. Okay. Sometimes there are exit fees, but exit fees are also not there forever. They taper out. Hedge funds are again long-term strategies, not as long as private equity, but could be 1 to 2 year type of strategies, a little more than 1 year actually. So they would require you to keep your money for a longer period of time, because otherwise you do this strategy and you have to wait, right, for the market to realize what has happened, for the market to identify that these stocks are actually undervalued, these stocks are actually overvalued, and for prices to adjust. So that's not going to happen overnight. If that happens overnight, then that means either there's a lot of some insider trading that's going on. That's luck sometimes, right? It might take some months, years for this process to actually happen, for market to start seeing the results of the company, to understand that these companies are undervalued, these companies are overvalued. Okay. So because of this, they are longer term, hedge funds are longer term investors. And you can see Jones, as the GP, committed his own money and he asked for a performance fee of 20% of profits. That's the 2 and 20 structure. The birds are that 2 and 20 structure. Yeah. So the management fees are 2%. Performance fees are 20%. I mean, different for hedge funds will have different management fees and performance fees, right? But just like different private equity companies. But typical structure, most common that you will see in the markets are 2 and 20. Okay. And exempt from SEC regulations. Yeah. So the advantage about these long short strategies, why we call these strategies, why we say they're hedged, is because you make money regardless of how the market is operating, because it doesn't depend on the market operating, right? Because market might be going up, might be coming down. You're only interested in this set of shares that you think are undervalued and overvalued. Not a set of shares you're buying because you think the market will perform well or the market will not perform well, because you think the economy is doing well. Therefore, the share prices are going to go up and therefore I buy shares. That's a different strategy. That's a long only strategy, right? That's not a hedge fund strategy. Typically, that's a mutual fund strategy. But if you are looking at certain sets of stock, done the research, identify these shares are undervalued, these shares are overvalued, that has nothing to do with the economy. That has to do with the fact that investors haven't identified the true value of the shares. So therefore, when you buy these, you're hedging the two together, where the increase in one is supposed to offset the decrease in the other. And whether the other share decreases, you're making money. And when the share increases, you're making money. So whether the market is moving up or down, based on the shares movement of undervalued or overvalued, you're making money. Okay.
In that case, if the market moves in one direction, aren't you going to make money in one part of the strategy and lose money in the other part of the strategy, and then
you can.
Oh.
So that's part of the reason why we say hedge funds are, there are other, what do you call it? Hedge funds are higher risk, because that can also happen, but technically you're looking at shares in terms of so let me show you some strategies, right? So for example, typical hedge fund strategies, and this slide in particular is not a slide that will be tested. These are just to identify or to understand what are different types of ways that hedge funds try to make money, but these strategies will not be asked from you, right? The other slides will be can be tested, but this slide will not be tested, right? So you have the long short strategy that we just spoke about. Same long short strategy, iteration of that is what we call the market neutral strategy, where you have zero net exposure. That means your long stocks actually equal your short stocks in value, so that any amount of movement doesn't impact you. But you can understand it a little bit better in something like this, for example. Okay, so here a firm's undervalued security is bought, and the same firm, its overvalued security is sold, right? So in this case, in a capital structure arbitrage, you might think that the share is undervalued, so you buy it, meaning you go long on it. But the debenture of that company might be overvalued, so you go short on it. That's a strategy where you're saying this company, it's the same company, the debenture is overvalued, the share is undervalued, and what you do is you long and short the movement, so that ultimately what you're looking at is when the valuation is correct, you're going to make money out of it. Merge arbitrage strategies. Merge arbitrage strategies, here you can see when two companies are merging together, most of the time there might be overvaluations or undervaluations. The target company and the acquiring company, you will see that there can be differences in valuation. Usually the target company's prices go up, acquiring companies' prices come down, and the merging companies' prices will be different. So you will take, depending on how the prices are moving, you might do an arbitrage based on that. Convertible bond arbitrage. Convertible bond arbitrage is something like, for example, in a convertible bond, if you buy a company's convertible bonds, you're getting, at some point, you can convert it to equity. If you remember the example that we had in our notes, something like you can get, for every 100 rupees, you can get 5 shares, 5:1 convertible, which implies that the cost of the share is 20 rupees. Based on whether this is overvalued or undervalued versus the current market price of the share, okay, you can buy or sell the convertible bond and do the opposite strategy for the share of that company to make a profit. So these are all long, short strategies in certain ways, right? Then you have distressed security arbitrage. Distressed security arbitrage, sometimes in emerging markets, you don't have, like Sri Lanka. You had certain, we know of cases that are going with certain hedge funds, right? Distressed security arbitrage is not necessarily where you have a long, short strategy, but you're identifying, in this case, countries, sometimes companies, right? Where there are distressed securities, like in our country, are sovereign bonds, right? For example, ISBs. You identify the ISBs, you look at where the prices are trading, you make a call or do some calculations in terms of where the price should be trading or how much your recovery value is, right? So if the prices were trading at, let's say, 30 cents on the dollar, or for every 100 rupees, $30, okay, there's a certain amount that you're assuming in a bond. Usually, how do we do the valuation? We say, okay, we assume that these are my future cash flows, and based on the present value of my future cash flows, this is how much I'm going to get, right? In a distressed security, the point is, on a 100 rupee face value, I'm not going to get back 100, right? So this 30 rupees has been valued based on the assumption of something that I'm not going to get back 100, but maybe I'll get back, let's say, for example, I'll just put some number and say 60 rupees or 100 rupee face value, right? That's how today this bond's price is worth 30 rupees. In a distressed security arbitrage, maybe the hedge fund will look at it and say, no, this country has these things, and depending on these factors, we can probably get 70 rupees or 80 rupees on the dollar, right? Or 70 rupees on 100. And therefore, this security is worth more. So I'll buy it today at 30 because it is undervalued, and wait for the actual debt restructuring to happen, which could be a company, or in our case, Sri Lanka, right? And I will recover, my recovery value will be higher, and therefore I'll be able to sell these bonds at a higher price. So if you look at like the Hamilton case, the Hamilton case that's going on in terms of the ISBs, right? Without getting into details, these are hedge funds that essentially looked at being able to recover everything, okay, because they were given assurances, or they claim that they've been given assurances by the governor at the time that there won't be a default, right? And therefore, they were expecting to get everything or a substantial amount in terms of the repayment. So they thought that the bonds were extremely undervalued, and they took that risk, and they came back, and now they're finding that actually we're going through a restructuring, and the claims are that false representations have been made, and all of these different things, right? So there are much more things in the case. I don't want to go in and say that this is the only thing, right? But it's part of it. But that's the type of thing you will see. That's why you had a lot of hedge funds although we were looking at a distressed nation 2-3 years back, where our bonds were trading at very low prices. who are buying this? There were still people who were buying this, right? Some of them were hedge funds trying to make a big profit on that investments. Last week, when we did securitizations, I was telling you that how in securitizations there were hedge funds that were manipulating the portfolios so that they were actually, in your securitization, you pick and choose to your SPV. And if the investor is not careful, you're technically supposed to be picking and choosing the good loans to the SPV, right? The hedge fund worked with the investment bank to choose the bad loans to the SPV. They were fined. They were fined, and there were severe penalties that were imposed when this was found out, but too late because investors lost out, right? And by the time this was found out, I mean, the SPV has defaulted, investors have lost out. Then only everything came to light. But the hedge fund worked with the investment banks to identify assets that can actually have higher propensity to default, and they transferred that to the SPV, and they shorted these bonds that were issued by the SPV, the CDOs that were issued by the SPV, they shorted it, right? While investors were buying it, they shorted it. They were expecting that with the global financial crisis happening, because certain people were identifying that US was in a precarious position. There were a lot of things that was happening that could lead to some sort of crisis, right? The extent of the crisis, I'm sure nobody knew, but things were happening that could lead to some sort of uncertainty, volatility, where prices can come down, interest rates can shoot up, and they were taking positions on that. This, of course, is an unethical practice, you can see. But these unethical practices are there because hedge funds can make millions and billions for its sponsors, its GPs, right? Raj Ratnam, Galleon Fund was Raj Ratnam, right? From Sri Lanka. Fund manager of, at that time, one of the largest hedge funds in the world, right? Imprisoned for insider trading. But what was the motive? Forget about what happened or how it happened or anything. What was the motive? The amount of money that you can make from these investments, because you're sharing 20% of that profit that you make. So there's very high motive to, it's not that everybody will carry out illegal practices, but there is incentive to do it, right? So it doesn't mean that, but hedge fund managers are typically some of the richest people that you will find, right? For example, some big hedge fund managers, you would have heard of George Soros, right? Quantum fund management. Ray Dalio, Bridgewater Associates, Jim Simmons, Renaissance Technologies, Ken Griffin, Citadel. These are some of the biggest hedge funds that are there right now. Tiger Global Management, Bridgewater Associates, right? So this is a older one, but the names haven't changed, right? And the rankings are like pretty similar, not the same. That's why I didn't change this, because this has all the faces and everybody's there in a better way than the newer infographics that are there. So which is why I didn't change this. So these are some of the bigger hedge fund managers that are there. Okay, so like 100 million to a million minimum investment, then accredited investors, right? Accredited investors who need to have net assets exceeding 1 million, 200,000 earnings. If you're married, 300,000. Long-term commitments can be in the range of 1 to 2 years, sometimes higher. Here they can invest in real estate, derivatives, currencies. 2009, or is it 99? When the Thai baht crashed. These were people identifying that there were certain things going on and taking huge positions and taking advantage of the market, and other people are suffering, right? But they are taking calculated positions. It's not something illegal that's happening. It's identifying anomalies in the market and taking advantage of it. Okay. Leverage, high fees, 2 and 20, little regulation, right? And the biggest SEC regulation that is there is to make sure that there is no retailization of hedge funds, to make sure that smaller investors are not investing in it. So hedge funds, there are strict guidelines in terms of how they can advertise, how they can get investors to come and invest in their funds. Okay. So this is an example, right? A very famous typical example of how a hedge fund can give you big returns as well as sometimes big losses. So this hedge fund called LTCM, Long-Term Capital Management, was again at that time, this was in the 90s, late 90s, I think, late 90s. One of the biggest hedge funds that were there. It was headed by Myron Scholes and Robert Merton, right? So if you all have heard of the Black-Scholes model, the Black-Scholes model won a Nobel Prize for pricing options. Okay, so the Black-Scholes model, Scholes and Merton were part of this hedge fund. They were partners in this hedge fund, right? So Scholes, Merton, and they had 30 other PhDs working in this hedge fund. Right? That's the type of analysts that were working in this hedge fund. Okay, so you had this hedge fund that were trying to look at market anomalies and trying to exploit market anomalies. And at one point, they noticed that in the market, it was a graph like this, where they noticed that the 29.5-year Treasury bond versus the 30-year Treasury bond, there was an anomaly in pricing. So when you draw the price versus across time, which one is the 29.5-year Treasury bond? Which one is the 30-year Treasury bond? Blue or red? Which one is the 30-year Treasury bond? A or B? I'm drawing the price versus the 29.5-year. If I drew the interest rate, which one would have the higher interest rate, 30 or 29.5? If I plotted the interest rate of the 30-year bond versus the interest rate of the 29-year bond, which one would have the higher interest rate? If I plotted the 30-year bonds interest rate versus the 5-year bonds interest rate, which one would have the higher interest rate? Which one should have the higher interest rate?
30-year bond.
30-year bond.
30-year bond. Why? Long-term bonds typically have higher interest than short-term bonds, because typically you're asking for a higher risk premium, right, on the long term versus the short term. There is illiquidity premiums. There is, like, because of the time that you're holding it. So 30-year bonds will have, the longer the tenure of the bond, you will have a higher risk premium associated with it versus a short-term bond. So of the 30-year bond should have a higher interest rate than a 29.5-year bond. So in terms of price, the 30-year bond price is higher, or the 29.5-year bond price is higher in terms of price?
29 years bond.
Yeah, 29-year bond price will be higher than the 30-year bond price, because prices and interest rates are inversely related, right? So therefore, A is the 29.5-year bond and B is the 30-year bond. Okay. So these guys, they were looking at the price trends over a long period of time, and they noticed that the 20-year bond and 29.5-year bond and the 30-year bond, pretty much the prices move in tandem, lockstep, right? You can see very close to each other. similar premiums. Sometimes the premiums are higher, sometimes the premiums are lower, but similar premiums, and they work very close, and they are very close to each other, which is fair, correct? It's fair. Because what is the difference between 29 and a half years and 30 years? It's nothing. Okay. At that point, it's not like a 5-year and a 30-year. 29 and a half year and 30 years is pretty much like 30 years, right? So they found out that these bonds usually move in the same direction, the same way. But there was this period where there was an anomaly where you saw that the spread had widened. Right? Spread had widened. So you can see the spread here versus the spread here. Okay. Now, their expectation was that, okay, the spread widening is an anomaly and the spread will come back to normal levels, meaning this will come down in price and this will go up in price, right? So that the spread will narrow back to its original old levels. So what did they do? Which bond is undervalued? Which bond is overvalued? Which one is undervalued? Which one is overvalued? This is something like this, and that was there. Something like this, right? Where this was going up and this was coming down. I've just like extended made the picture bigger. So this is the spread that you have, right? This is the spread that you have. Now here the spread has widened. This price has come down. This price has gone up more than it should. Because what should it be doing? This price should be something like this. And this price should be something like this. Because this should be the spread. So what is undervalued? What is overvalued? What price has come down more than it should, and what price has gone up more than it should?
29 and a half is overvalued.
Yeah.
And 30 is under.
Yes. 30 price should be here, but it is here. 29 and a half price should be here, but it is here. So 29 and a half is overvalued, 30 is undervalued. So the assumption is that 30 price should go up later on, and 29 and a half price should come down. So what did they do? They purchased the undervalued shares. They went long on the undervalued shares. How did they go long? Part of it was the fact that they shorted the overvalued shares. They didn't have the 29 and a half with them. They shorted the 29 and a half, right? Used part of that money and part of investors' money to go long on the undervalued shares, right? Now you're using money you don't have and you're using investors' money to go long on the undervalued shares, right? So you're leveraging as well. And actually, this strategy worked for them. They did really well with this strategy because after a while, there was no rationale for these two bonds. They are like 29 and a half years and 30 years. It's pretty much like the same bond, only 6 months apart, long time from today, right? So pretty much there was no rationale for the bonds to deviate. So that anomaly corrected. And with that correction, these guys made billions of profits for their investors, right? They were the best. Now, After a while, so this was a strategy that really paid off for them. Yeah. After a while, they saw a similar phenomenon occurring, but this time it was not on the 20-year and the 29.5-year government bonds. This time they were seeing the government bonds versus the AAA corporate debt, right? AAA or AA, I can't remember, but corporate debt. So you can understand that the corporate debentures, this is the debentures, and this is the government bond. Okay? Again, because so I'm closer. Right, something like this too. And they saw that the debentures were deviating price and the government bonds were deviating in price. Okay? So this was overvalued and this was undervalued. You understand, I hope, why debentures are this. I'm drawing the prices, right? When I'm drawing the prices, debentures have higher interest rates because they're higher risk than government securities. They have lower price. Government securities are lower interest rates, higher price. Okay. So they saw the government bonds were overvalued, debentures were undervalued, right? So they did the same strategy. They shorted the government security and they went long on the debentures. They purchased more debentures by leveraging, by borrowing money. Now, unfortunately, this strategy happened around 99, 2000 or something like that. And around 2001, right, Enron collapsed. Enron was the third, if I remember correctly, the third or the seventh largest company in the US. I think seventh largest company in the US, right? It collapsed. It completely collapsed, right? One of the biggest collapses that you see in the US. So went bankrupt. What happens when a big corporate goes bankrupt? What do you think would happen to corporate bonds? What do you think would happen to corporate bonds? What happened to fixed deposits when the golden key calamity was happening or the Pramukha bank crisis was happening? What happened to fixed deposits?
People are withdrawing.
People were withdrawing, right? People don't want to invest in it. What do you think happens to corporate bonds when a big corporate collapses, goes bankrupt, and can't pay their debt?
Prices crash.
Prices crash, exactly. Right? It's not just Enron's prices. Obviously, Enron went bankrupt. All corporate debt suddenly became very risky in the eyes of the investors. Right? Investors became risk averse. They didn't want to, like a deposit run. These guys, investors, didn't want to invest in corporate debt. So therefore, what happened? People started fleeing from corporate debt. They started selling at a rate. And what happened to prices? Prices crashed. Well, I won't draw it from here. That's wrong. Prices further crashed. Okay. Prices further crashed. And government securities on the other side, there was a run for safety. Okay. People were, because what would happen in a deposit run? You're taking money out of Pramukha Bank, not just Pramukha Bank. When Pramukha Bank is collapsing, you're taking money of Pramukha, you're taking money out of commercial or FHNB or Ceylon, of every single bank across, and you're putting it everything, either you're keeping it home or you're putting everything to state banks. Right? That's typical mentality. Okay. You're taking out it of the risky assets and putting it into what you perceive to be lower risk. Okay. So what was happening? The debentures were crashing and the government securities actually government security prices skyrocketed. Why? Because people were investing more and more in government securities. Everything that they were taking out of these debentures or corporate debt, they were pumping back into government securities, to bonds. So bond interest rates crashed, prices went up. What was happening here? You have shorted a security, expecting the prices to come down, but the prices are not coming down, prices are going up. When that happens in a shorting situation, you see that next week when we do shorting, when that happens, you have to put more money. You have to put more money to make sure that your position is covered, right? Because otherwise, the broker who lent you these securities is at risk. The broker or dealer who lent you these securities is at risk. So they say, not enough money, put more money. So you had to find money, you had to borrow or whatever, you had to find more money and you had to put more money. Again, same thing here, right? You purchase shares, and when you're purchasing shares, you haven't just used your money, you've used borrowed money, right? You've margined or leveraged, right? And when you've margined or leveraged, and your share prices are crashing, coming down, you expected it to go up, but it's coming down. Again, your broker would call you up and say, not enough money, put more money. You're putting money here, you're putting money here. LTCM went bankrupt. They had to be bailed out, right? They had to be bailed out. A hedge fund being bailed out is not a typical thing that would happen in the system. But LTCM at that time was so big, right? I mean, central banks wouldn't look at bailing out of Federal Reserve, in this case in the US, wouldn't look at bailing out private investments of very rich individuals, right? Or shouldn't look at. But their hands were in so many places in the system, right? They had borrowed so much from different banks, from different, because they were highly leveraged. So the thought process was that if they go bankrupt, it would be a systemic risk to the US stock markets. And there might be a few other smaller banks, for example, or smaller counterparties that might collapse, which is the reason that they had to go through government bailout. 2 Nobel Prize winners, 30 PhDs worked in that company. And this is the type of risk that a hedge fund can carry, where you can go completely belly up. And in this case, obviously, the investors lost a lot of money. I don't know how much they would have recovered, but very little. So they would have lost nearly all of their money. That's the type of risk that you're taking. Earlier, with the earlier strategy, they made a huge amount of money, but they would have lost it all. They could have lost it all in the next strategy. Okay. That's why hedge funds, in part, are not a vehicle that's open for retail investors. Any questions here? Okay. So that finishes the hedge fund section. The most important takeaway is the understanding the differences between what are mutual funds, what are private equity, what's private equity, and hedge funds, right? Understanding the similarities and the differences, why these instruments are there and why they operate in different ways and regulated in different ways, and how they operate, right? That's the most important takeaway that you have. Any questions?
Vindhya, in the last example, you said most of them lost their money almost entirely. But
I said I don't know how much they lost, but they would have probably lost quite a bit of money. The investors.
yeah, but if the government had bailed them out, they would have
Government
recovered.
would have bailed out the hedge fund in terms of being able to repay back the loan that they have taken,
Only to the extent that the loans are covered.
not to repay back the investors. I doubt it.
Okay. Okay. Thanks.
Other questions? So we move on to investment banks. I'm sorry, I sent that set of slides pretty late. I only sent it this morning. It's available on LMS and I've also emailed it. So if you don't have it, I'll give you 2 minutes to get the slides. Start on investment banks.
Miss, sorry, just one more on the hedge funds.
Yeah.
So it's always a hedging strategy, is it? There's always a.
No, not necessarily. So
They
it
don't
is
take.
predominantly a hedging strategy. Predominantly a hedging strategy. That's why I said, just like my example on Union Bank, predominantly private equity is private equity, but doesn't mean that it is always private equity. So, like, for example, Union Bank is a listed company when they came in, when they invested as well. When TPG, the private equity company, came and invested in Union Bank. So, it's just that things have evolved now in that sense, that just because you use that private equity label, still this went as private equity because you're coming to Sri Lanka, illiquid market, takes time to get out of a very high investment. So in that sense, it was considered private equity. Just like that, hedge funds also distressed. For example, that distressed debt that I was talking about, where you come and invest in countries like Sri Lanka, there are no derivatives to hedge yourself. There are no shorting to hedge yourself, right? So in that sense, they would have come in with an open position, taking an event-driven strategy, expecting a certain event to happen, and expecting a certain outcome from it. So those are long-only strategies. But most hedge funds would be hedged. Does that make sense?
Yeah. So predominantly, the strategies are hedged.
Predominantly, their strategies are hedged, but there are certain strategies which are long only, especially where you don't have tools to hedge it.
So whatever these, especially these distressed funds are all.
Yeah. Quite a lot of the distressed funds would probably, where you're coming to these emerging markets, probably you won't have tools to hedge it.
Thank you.
So I'll give a minute for anybody who doesn't have it to download it.
Just one more on hedge funds. Yeah. So when you say hedging strategies, it's never a one-on-one hedge. No, it's not like a basic forex hedge that a company would do, like a forward or something. It's not like you short the same stock and long the same stock, where it's a one-to-one hedge. It's always.
Yeah. It's highly unlikely that it will be a one-to-one hedge. It will be like in that capital structure type of one that I was showing you, same company, but different instruments. Or it will be different companies. Long short structures would be different companies. It would never be the same company. Market neutral is though, where you're trying to hedge, make it zero. The beta is zero. And you're trying to work out the alpha. So you all know of what is beta, right? Beta is your market risk. In shares, you might have come across the terminology. You'll have some section on beta, right? That you'll come across in your exams. In your working. For your course. Not? Yes or no? Beta is market risk. So it's how volatile or sensitive your stock is to movements in the market, right? Versus alpha is how undervalued or overvalued you are. So what you're trying to do is, in a market neutral strategy, make beta zero, right? So for example, if you have a portfolio where the beta of your portfolio is 1.3, or let's say your beta of your portfolio is 2, right? You will find another portfolio of different shares. So you will find one portfolio of different shares which are overvalued, which has a beta of 2. And you might find another portfolio of different shares which are undervalued, which has the same beta, right? Altogether, they make the same beta. So in this case, you will buy the undervalued portfolio and you will sell the overvalued portfolio. Overall beta is 0. That means you're not taking market risk, right? You're not taking market risk, but the undervalued portfolio has positive alpha and the overvalued portfolio has negative alpha. Alpha means how much you are overvalued, how much you are overvalued or undervalued by. So therefore, essentially, you're trying to say that this is negative. So you're trying to increase your alpha or the amount that you are going to make, that additional return that you're going to make while keeping it. This is what we call a market neutral strategy. So long short strategies can be market neutral, where you completely make your beta 0. That means no market risk. Or it could be net long or net short, meaning a little bit more long shares or a little bit more short shares are in the portfolio. Those are what we call long short strategies. So, like I said, that part is not going to be tested. It's just out of interest in terms of what you asked your question. The strategies are not going to be tested. Understand the structure, the purpose, the risks or not non-risks of the 3 structures that we spoke about, right? So mutual funds are obviously going to be not obviously going to be tested, but you need to know the concept of mutual fund the most, because that is the most relevant for you as retail investors, right? Then private equity, then hedge funds. But that's the importance of understanding the underlying features of each of these. Does that make sense in terms of the question that you asked?
Yes, Linda, thank you.
Okay. Investment banks. So today we're going to talk about investment banks. We'll come to security brokers, dealers section. We'll have that, what we're going to talk about in terms of long, short positions, margin trading, and stock borrowing lending that we just introduced in Sri Lanka and all of that, right? Today we talk about investment banks. So in your understanding, what are investment banks? What are investment banks? You all know of investment banks in Sri Lanka, right? What do they do? Some of you would know of investment banks in Sri Lanka. I know some of you are working at investment banks in Sri Lanka. What do you all do?
Enable clients to raise capital and advise clients on buying and selling companies.
Absolutely. So, investment banks, there is a typical, for some of you who don't know investment banks, some of you might be thinking, and this is a common thing that I get in a lot of classes across the board in many places. A lot of people think that investment banks are banks for making investments. Because that's what the terminology looks like, right? Investment banks are banks for making investments. They are not. It has nothing to do with investing in modern context. Investment banks have nothing to do typically with investing. Okay. Investment banks now are not even banks. So when they started out their historical roots, you would talk about merchant banking, where, like when you wanted to For example, when you were going on your next exploration in terms of these countries from Britain or like whatever, and you had all these ships from Europe or whatever, and these ships needed to be funded for these Far East, uh, trade and all that. You had merchant banks that were giving money, funding these ventures, and they would then look at how they would make money back from funding these ventures and all that. And that's like the beginnings, the roots of how investment banking has evolved, right? Now, in terms of investment banking typically, they're not banks, okay? Typically, right? And they are not for making investments, not for investing in stocks, bonds, art, gold, copper. No, they're not for making investments, right? So that terminology now is a little bit of a misnomer. Investment banking, though, correctly said, is essentially trying to help people raise funds or provide advisory services. So these are intermediary entities that try to arrange transactions. Okay, arrange transactions, help people, again, like from the very first lesson that we talked about, help people who have money connect with people who need money. But these are not typically people who need money. These are typically corporates who need money. So investment banks work in large scale with corporates who need money, and they help them raise money in the form of either share market, like an IPO, or in terms of debt, like, debenture issues, securitizations, commercial paper, right? With all of these different instruments, they help connect investors with corporates who need money. Connect. They are not putting, they can, certain investment banks can, but typically it's not about them putting money and giving corporates money. They don't take deposits, right? Commercial banks, you know how commercial banks work, right? Not commercial bank and other commercial banks. How do they work? They take deposits. They take deposits from investors, and then they lend that money to corporates or to individuals or whoever, right? Investment banks don't take deposits. They're not deposit-taking institutions. What they do is, though, they do help corporates raise money in terms of equity or in terms of debt. How do they do this? By helping connect the corporates with other investors, right? These other investors could be high net worth individuals. It could be, in the case of an IPO, retail investors as well, pension funds, fund managers of unit trust companies, investment management companies, right? Any type of big investors that are looking for different investment purposes, investment banks will be that middleman who has that networking capacity to be able to bring together the investors with the corporates that are looking to raise money. Because corporates are not in the business of networking and figuring out, okay, who has money, who should we approach when we want money, and in what way, right? Certain bigger corporates might have treasuries to do that, but very few will. If you're a corporate and you want to raise money, you can go to a bank, you can ask for a loan. Or if you want to come to the capital markets, it's a little bit daunting. You don't know, how do I come to the capital markets and raise money through a share offering? Or how do I do a debenture issue? Who do I approach? What is the process? All of this is done by the investment bank. So typically we say investment banks are sell-side entities. Sell-side entities. Now, what we spoke about, mutual funds, investment management houses, private equity investors, hedge fund investors, all not investors, sorry, hedge fund managers, private equity managers, mutual fund managers, investment managers, right? These are all buy-side institutions. Investment bank is like a stockbroker, is a sell-side institution, right? They help sell the securities of corporates, which can be shares in the form of IPOs, which can be debentures, commercial paper, securitized paper. They help sell these instruments to buy-side fund managers or other investors, right? Buy-side fund managers like mutual fund managers, investment managers, private equity managers, very rarely private equity managers, but yes, private equity managers as well. Or actually not very rarely, you can have mergers and acquisitions. And hedge fund managers, right? Insurance funds, pension funds, these are all buy-side fund managers. So that's typically what an investment bank does. Any questions here? So investment banks are what we call, it's a financial services company. Financial services company that's on is typically advisory based financial services companies. Okay. So when we talk about investment banks, some of the bigger investment banking names that you all should know of, Goldman Sachs, Morgan Stanley, Bank of America. These are some of the bigger JP Morgan, bigger investment banks that you should know of in the investment banking industry, right? You hear these names, you should know that these are investment banks. So you can see here, this is as at April 26 March, right? 26 up to 26 March. So the biggest investment banks in terms of the fees that they have earned for the first quarter of this year, 2 billion by JP Morgan, 1.6 billion by Goldman Sachs. These are the bigger names in investment banking. And where have they earned these fees from? They've earned these fees from mergers and acquisition transactions, helping companies raise money through IPOs, helping companies raise money through debentures, commercial paper, securitized paper. I mean, they will call it different names, right? Project financing loans. All of these are what helping companies raise money and providing advisory services. Okay. So investment banking typically covers two areas. One is M&A, mergers and acquisitions, where they help the company when they want to spin off a division or they want to sell it to somebody else or acquire another company. Investment banks are the people who will provide the advice on how to do it, at what price to do it, who to sell it to. They will do that entire gamut of facilitating the transaction, working with the lawyers, finding the right partner to partner with, right? Doing the valuation, the pricing. All of that is what we call M&A advisory. Or they will help you raise money. Now, this terminology underwriting is a terminology that's used in the US to actually mean raising capital. Now, we use in Sri Lanka, how we use underwriting is a little different, right? I think your understanding of what is underwriting will be a little different. But in the US, when they speak of underwriting and you read any of these textbooks, when they talk about underwriting, they're talking about raising money. Okay. Raising money through either selling stocks or bonds to investors. So what are the two main areas that investment banks will engage in? Mergers and acquisition, advisory services for mergers and acquisitions, and helping companies raise funds, or what we call underwriting. Okay, underwriting. So in Sri Lanka, we don't call it underwriting. Helping companies raise funds, but typically the singular word for it is underwriting. Okay. Investment banks, these are the two main services investment banks provide, right? But now investment banks again have evolved so much. You can actually, we have what we call full service investment banks, traditional investment banks and full service investment banks. So traditional investment banks are investment banks that engage in these advisory services and underwriting services, right? Versus if you're looking at full service investment banks, it can include not only underwriting, M&A, it can include stockbroking, equity research, fund management, even commercial and retail banking. Okay. So full service investment banks are like, a lot of the time, you will see like these big investment banks like Goldman Sachs, they will have their own asset management divisions. They will have, so Morgan Stanley's, they'll have their own asset management divisions. They'll have all these different other additional services that they provide, not just sell side services, buy side services as well. So investment banking in that sense has evolved because the larger the investment banks get, you see that the services have expanded and evolved. But traditional investment banking services are essentially what? Advisory service. They provide advice and they charge a fee for that advice, helping people raise money, and they charge a fee for that. That's what investment banks do. Questions? In Sri Lanka, investment banks were not regulated until very recently, right? So in 2021, this act, the SEC Act 2021, actually defines, we don't call it investment bank because that word bank, right? So now we have this definition called corporate finance advisor. So if you want to operate an investment bank, now you have to get this corporate finance advisor license, CFA, in that sense, license from the SEC. So they are not called investment bankers typically in Sri Lanka anymore. That definition is changing because, they do the same job. They are called informally investment bankers, but the official terminology is corporate finance advisors. Who are corporate finance advisors? They're any person or business who, for a fee, will help provide advice on how to raise funds, compliance with fundraising requirements, compliance with listing requirements, and they will help structure financial products, takeovers, restructurings of listed companies, right? So this is the definition so far that has been given to corporate finance advisors. And if you want to engage in any of these services, now you have to take a license from the SEC. Still yet, every single investment bank operating in Sri Lanka has not taken this license because there is a certain transitionary period, right? So investment banks, certain investment banks are in the process of transitioning and getting the license. If they want to engage in these services, there will be some cutoff date where you will have to then, after that point, you will not be able to engage in these services officially without having an investment banking license, or what we call a corporate finance advisor license. So typically, investment banks in Sri Lanka are fee-based investment banks. You can have fee-based investment banks and you can have fund-based investment banks, right? What do you mean? What is the difference between the two? Fee-based means you provide services for a fee. Fund-based means you have your own money which you can invest. Typically in Sri Lanka, all investment banks pretty much are fee-based investment banks. And now with the new corporate finance advisor license, you will have to be fee-based, right? It says here, for a fee or commission, engages in this business. So you are not fund-based, right? You will have to have a separate license to be fund-based, or what we call underwrite. So what is the difference between what is fund-based? Fund-based is where the investment bank has its own money that it will use to help companies raise money. Meaning, when companies are raising money, part of that money might go to investors, right? Might be from, not go to, might be from investors. Part of that money that they are helping the company raise might be the investment bank itself making the investment. They have what they call a prop book, a proprietary book, right? Proprietary book means they have their own money and they will trade using on different instruments using that money. Proprietary trading, right? Do you remember last time when I showed you those slides on subprime crisis? One of the slides said, the investment bank said, no, that last piece, that junk piece, we will buy for ourselves. If you remember, right, last week, right, we did securitizations. And in securitizations, we were talking about the cash flow waterfall, how you had the AAA securities, and then you like came down the waterfall, and now you were left with this junk piece, the equity tranche. And then the junior was asking, okay, who will buy the equity tranche? It's junk. Essentially, and the investment banker was saying, essentially, we'll buy it ourselves. That's part of that, just an example of using your own money to fund the company who wanted to raise money through the securitization, right? Here they were essentially paying themselves something in terms of a big interest rate, but sometimes they would buy these, sell these, and do proprietary trading for themselves. So that's an example of fund-based investment banking, where the way that they make money is through trading activities or underwriting. So typically in in the US, when we talk about underwriting, one is underwriting means raising money, right? Also, if you remember, we have in Sri Lanka, when we talk about underwriting, what does underwriting mean? Underwriting means, what does underwriting mean in Sri Lanka? What does underwriting mean in Sri Lanka? What is your understanding of underwriting? You all have heard of the term, no? What is your understanding when you say underwriting?
Giving a assurance for a fundraise, something like an IPO.
Mhm. Yes. And how does that? That's right. And how does that work, though?
Whatever, so if you're going to the public markets to raise money, whatever money that you fall short in raising from the public markets, the underwriter will fund that portion.
Exactly. Right. That's how we work in Sri Lanka when we say underwriting. What we are saying is, okay, a company wants to raise money through an IPO. They will say, I want to raise 5 billion rupees. They will go to the market and they'll say, I want to raise 5 billion rupees, let's say, for example, right? So you have all these investors who come and give money. The company can have a assurance, a guarantee, in case they fall short of the amount that they want to raise. There is this third party who is there to fund the gap, right? To fund the gap. So the IPO fails. In case the IPO fails and the company is not able to raise the total amount of money that they want to raise, there is a third party who we call an underwriter, who is available to fund the gap. This is what we mean by underwriting in Sri Lanka. So what is the gap? In case the company wants to raise 5 billion rupees, they come to the market, ask people for money, right? Investment bank does the marketing, all of that, right? And they raise 3 billion. Now they're short. They want to raise 5 billion, they raise 3 billion. They're short. So you can have an underwriter who says, if you're short, I will put the rest of the money in. So now the company is guaranteed that they will raise the amount of money that they want to raise, right? So it could be that they're not short and they get all the money that they require, in which case the underwriter will not put anything in. But this is like a guarantor. Just like you said, this is like a guarantor. And this is how underwriting works in Sri Lanka. So in the US, we said underwriting typically means any fundraising is underwriting, right? Within underwriting, here I'm talking about what we call firm commitment underwriting. Firm commitment underwriting, we'll talk about this again in another slide. In firm commitment underwriting, what happens is, typically in the US, how an IPO will work, when I say typically, it means most issues, right? Doesn't mean all issues. When the company wants to raise money, and the same, let's say 5 billion, what will happen is the investment bank will buy the entire issue first. They will buy the entire issue first, right? And then they will sell it to the public. So in Sri Lanka, how does it happen? with underwriter or without underwriter, you straight away sell it to the public, right? And you have a third party guarantor in terms of underwriting who says, if there is not enough demand from the public, I'll buy it. I'll buy the remainder. Here, it's not like that. In firm commitment underwriting in the US, they will buy all the shares to their book. That's why it's fund-based investment banking. They will buy all the shares to their book, and then from their book meaning they'll use their own funds to buy the shares. Now it's their shares. And from their shares, they will now sell it to the public. Okay. So the IPO is done by the investment bank on behalf of the company, yes. But they purchased it and then they are selling it to the investors. And they keep a margin. Right? That's what we call fund-based investment banking. So say the company wants to raise 5 billion, the investment bank will buy these shares, let's say, I'm just putting extreme examples here, at 4.9 billion, right? Why slightly lower than what the company wants to raise? Because this is the commission the investment bank will charge for the fact that they are giving a firm commitment to the company. You want to raise 5 billion, you're raising everything you want. Rest is fees, right? So they might buy it at 4.9, and that means I'll just put numbers here and say 1 billion shares at $5 each, right? At $5 each. They'll buy it from the company at $490 and sell it to the public at $5. They'll buy it from the company at $490 and sell it to the public at $5. And this is how they make the money. This is how they earn the fees, right? When they have a fund of their own, they buy it and sell it to the public. And that difference, that 10 cents per share, is the fee that they make. Now they're taking a risk here. If the public doesn't want to subscribe for this IPO, the investment bank might be stuck with more shares that they want to. They are not even making 10 cents on any of those shares that they can't sell. Company is happy because company got the money that they wanted. They wanted 5 billion, they got 5 billion. Sure, 4.9, that's after fees, right? Investment bank takes a risk here. But this is what we call fund-based investment banking, where they do firm commitment underwriting, buy it from the company, take the shares to their own books and sell it from their own books. So the IPO, and during that process, it actually gets sold from their books. Okay. This is what we call fund-based. So essentially, you have money of your own and you generate profit from that money by doing certain activities like firm commitment underwriting, like proprietary trading. But in Sri Lanka, and typically most investment banking activities, other investment banking activities, are fee-based. Fee-based simply means that you provide a service, you charge a fee. That's it. Okay. So what are the services you provide? You provide services in terms of IPOs. To sell your IPO, you help the company raise money through selling shares. In Sri Lanka, how do we do that? The investment bank provides advice, facilitates and liaises with the stock exchange, with the SEC, with the registrars, with the investors to help place your IPO, right? Debt structuring, M&A services, trading services, full service investment banking, asset management, mutual funds, fee-based activities. They charge a fee for investing in the market, right? They don't invest their own money, no. So equity research, fee-based activities. All of these, you can see here, of these activities that I've shown, of these fee-based activities that I've shown, the first two activities are traditional investment banking activities, right? These activities are additional activities that are full service investment banks. Questions? Okay.
When the underwriting is done in other markets or US, So does that mean that the sale to the retail investors are a secondary transaction?
No, it still goes as a primary transaction because it's simply an underwriting activity, right? So, therefore, it is simply a pass-through transaction. We are keeping a commission in that pass-through. So
Okay.
the investment bank is on behalf of the company selling. That's the only difference. Yeah. So what are the activities that investment banks will do? What are the things that investment banks will do? We've spoken about a few of these. Like, for example, commercial paper, right? Investment banks will help clients raise money through issuing commercial paper. For example, you know what commercial paper are. Commercial paper is where companies come to the market to borrow money for short-term purposes. We said commercial paper is a form of a promissory note where the company promises to pay you back. If you all remember your very first few uh, lectures, promises to pay you back after a certain period of time, short period of time, less than 1 year. They promise to pay you back a certain amount of money. Now, how do the investment banks help in terms of raising money through commercial paper? Company can do it by themselves. Companies taking a loan, not from the banks, they're taking a loan from the capital markets. Why can't the company do it themselves? Typically because if the company has a large treasury of its own, yes, some of these companies that have large treasuries of their own do it themselves. They can. If they don't have a large treasury of their own, they will outsource that activity to an investment bank. Right? Even where you have large treasuries on your own, investment banks have the advantage of knowing a lot more investors than you as a company treasurer might. You typically have very good relationships with the banks. You have dealt as a company treasurer. You deal with the banks. You know what the rates are. You have your relationship manager that you're talking to in terms of, negotiating rates and all that. You have that. You don't have that much rapport with the EPF fund managers, with the insurance company fund managers, with the mutual fund managers, right? All these other high net worth investors, you don't know them. You might not know all of them. Investment banks typically will have good access to a far better reach of clients, right? Which is why you would want to outsource, because when you have more alternatives with different types of clients, you can get better rates on your paper, right? Because if there is demand for your paper, then that means your cost of funds come down. If there is no demand, anyway, there is no demand, right? So in that sense, that's part of the reason why you would outsource this activity to an investment bank, because the investment bank will help you find investors, negotiate the rates on your behalf, and facilitate in terms of the issuing of that commercial paper. We spoke about securitized papers. In securitized papers, remember we spoke about how the investment bank will be the ones who are coordinating with the auditors, coordinating with the, lawyers, with the trustee. They will be the ones who are coordinating to create that structure for the company. They'll coordinate, they'll liaise with the company, get the underlying portfolio that is going to be pledged or sold to the SPV. They'll analyze the underlying portfolio. They'll coordinate with the auditors to make sure that the underlying portfolio is in line with all the requirements that the investors need. They'll coordinate with the legal documentation with the lawyers, right? And then they'll structure the instruments. They structure all these different trust certificates. We were talking about zero coupon papers and all that. They structure the instruments, and then they will talk to different investors and help the company sell these instruments. So, help structure, coordinate with lawyers, auditors, other stakeholders, and find investors. These are things the investment bank will do. So, facilitating raising money through commercial paper, through securitized paper, and because equity and debenture IPOs are slightly longer, let me jump to syndicated loans and project financing, right? Before we take the break. And then we'll come back after the break for equity and right. If you can just jump to loan syndications. We're still on helping company raise funds. Helping company raise funds, right? And how one other way investment banks will help companies raise funds is by facilitating loan syndications. What's a loan syndication? Those in the banking sector, what's a loan syndication?
If it is a single lending institution is unable, or if they consider it to be risky,
Right.
few of them get together and arrange the facility.
Right. Yes. Loan syndication is where you have several banks getting together and giving one single loan. So you have one single borrower who wants money, typically a company or a large project, right? Because it won't be an individual, right? Typically for a large project or a company, you have this person who needs money. But the problem is, like you said, the bank might not want to take the entire exposure of this project or this company because maybe the project is too big. Typically, the biggest reason for loan syndications is they are large projects, right? So the bank doesn't want to take that entire exposure, the size. It could be that they are overexposed to the company. It could be many different reasons, but biggest reason would be the size of the project and the bank not being able to or wanting to take that large exposure to their books alone. So what they would do is they would get into a syndicate. A syndicate is a group of several parties getting together, right? So several banks getting together is what we call a syndicate, right? It doesn't have to be banks, but that's a loan syndication. And they will give one loan. You're not taking multiple loans from multiple banks. What is the problem of taking multiple loans from multiple banks? You have a company, bank will ask for a collateral, right? The company has some property, maybe it has different pieces of property, but if it tries to pledge all of its property to all of these banks, that by taking multiple different loans, what will happen is it might have to pledge a lot more to be able to take the loans, because this bank will want a 60%, a 40% haircut. This bank will want a 40% haircut. This bank will want another haircut. What will happen? For every billion rupees that he borrows from these 5 banks, he'll have to give property worth 1.6 billion rupees to each, right? And that's also okay. It's the hassle of for every single bank to do that documentation to everything becomes a hassle, right? And the fact is, you're taking a single loan, and by the time you come to the 5th bank, they might see you're so highly leveraged that they might not want to give you loans. Instead, what do? You take that huge, whatever bigger loan that you want to, right? Now 5 billion, maybe a certain bigger banks can fund as one instrument, right? But whatever big loan that you want to, you can get several banks to get together and give you one single loan, one single paper that you have to sign. Property, yes, you still give that 40% haircut to the banks, but now as a consortium, syndicate, right? So this is what we call a loan syndication. Now, how do investment banks help in this process? The fact is, the company will need somebody to negotiate on their behalf. Some companies can do this on their own. Every single company will not go to an investment bank for a loan syndication. But loan syndications are something that investment banks do. And because of their expertise in doing loan syndications, they can add value, right? In terms of you're looking at coordinating with multiple parties for a single transaction. And you know that when you do a loan syndication, probably some bigger banks might want certain terms implemented versus smaller banks might not be able to get the terms and conditions that they want. Certain banks might have preferential terms. There can be many difficulties in negotiating something that everybody is comfortable with. This is where the IB helps. They help the company approach the banks, right? They will do it on their own. IB will find the banks that the company can work together with, right? Company doesn't need to go to every single bank and approach them and talk about the loan syndication and do that coordination of documentation. Company doesn't need to do any of that. Investment bank will approach the different banks. We talk about the syndication. Will be the independent party that coordinates and negotiates the terms between the syndicates. And then they'll liaise with the lawyers, auditors, if required, to finish that syndication so that the company can get its loan. So investment bank is there as a value-added service so that the company has a single point of contact to negotiate with multiple parties and for somebody else to coordinate this whole activity set. And the investment bank will charge a fee for this service. This is a fee-based activity. Commercial paper that we talked about, fee-based activity. Securitizations, fee-based activities. In Sri Lanka, right? CDOs could have been fund-based activities in the US. Can be fund-based activities in the US. Any questions here? Okay. Similarly, in project financing, right? Project financing is where you're looking at large infrastructure projects, or even it doesn't have to be large infrastructure projects. Large infrastructure projects is typical of this, but project financing is where you're relying on a project's cash flows to be able to pay back the loan. Okay. So the company itself might not be able to pay back the loan, or they have to rely on this project being successful to pay back the loan. And they might want certain loan conditions and terms negotiated, right? They might not want, for example, in project financing, it could be something like, you need time to build the project up, right? You need time to, let's say a manufacturing project, plant has to go up. After the plant goes up, the machinery has to be set in and all that. And then only manufacturing can start. And after manufacturing starts, to break even, sometime it will take some time. Right? For this whole process, it might take 2 years. And then only you start to really get cash flows in and you are able to pay back. Sometimes not being paid back for 2 years is not something a bank would like. So how can an investment bank help? Again, where there is an investment bank would help these companies talk to multiple different banks and figure out, okay, what's the bank that will give you the best rate, best terms for what you're trying to do. They will be the ones who will evaluate the project cash flows, the independent third party that evaluates the project cash flows and comes up with a structure in terms of how to safeguard and be able to repay from this project. And they'll go and present that to the banks and they'll negotiate the terms and conditions. They can negotiate the terms and conditions on behalf of the company, right? These are things that they can do. So again, banks have project financing divisions of their own that can do this job. And sometimes the issuers or companies can directly approach these project financing divisions, right? Sometimes that happens, right? Same way, it makes investment banks getting into it. What does it do? What is the value addition? One, the companies might get exposure to far wider variety of structures, far wider variety of, maybe they're working with a single bank and now they have exposure to multiple other banks who will look at the structure and come up, and you can have better terms and conditions negotiated. So sometimes you will see, typically people are very comfortable working with, this is my relationship manager, he'll give me the best terms, whatever, and they'll work with them. And that's it, right? You won't explore. But if you did, you'll find that sometimes you might be able to get better terms and conditions. And that's what the investment bank will help you do in terms of being able to show your project, analyze your project, look at the cash flows, structure something that is acceptable to the banks, and on that basis, negotiate better terms and conditions for you. So this is how they can, again, coordinate with the lawyers, offer it to multiple investors, maybe so they negotiate the terms as an independent third party. These are different things that they can add value by, and for all this, they will again charge a fee. This is a fee-based activity. Any questions? Okay. So securitized loans, syndicated loans, project financing. Yeah. Investment banks can do business valuations, business restructuring advisory. They will look at your balance sheet. For example, the investment bank can analyze your balance sheet and help you restructure your balance sheet. So certain times, for example, how would I say? You might have balance sheets that have very high levels of debt. Okay. Maybe this debt is very high levels of floating debt or fixed debt, or maybe you have your debt to equity ratio is not optimal. There can be many different problems that is not helping you achieve the best profitability or ROEs that your company can achieve. Investment banks can help in that process where they look through your balance sheet, especially where you have very high levels of debt. This is when companies want to engage investment banks to see how they can change it around, convert it maybe to equity, prepay the debt, and restructure the balance sheet. So a lot of the time when companies engage investment banks, they're probably looking at companies that are now going towards higher gearing, right, higher leverage, and they want to figure out ways of making their balance sheet look better or stabilizing their balance sheet, right? So in that sense, the investment bank can actually analyze the balance sheet, come up with different structures in ways to mitigate the risk that they see in the balance sheet, and which might hinder the company from actually borrowing more or getting more fundraising. So some ways are obviously to convert the debt to fixed rate to floating rate, to shares, right, to raise more capital through share market activities, things like this. The investment bank will give recommendations looking through the balance sheet and doing a forensic audit on the balance sheet. They will, not a forensic audit, sorry, that's a different thing, but doing an analysis on the balance sheet, they will give you different recommendations on how to optimize it. That's another thing that they will do. Okay. These two we will do after the break. So let's take a break. Any questions before that? Okay. Okay. Say that again. I didn't understand how you connected insurance brokers to the project financing thing. That's what I didn't understand. Yeah, well, not just find a better rate, right? Negotiating the terms and conditions are one thing. Valuation is another thing that they do. Valuation, analyzing the cash flows and structuring the project cash flows in a way that banks will find it acceptable to give the loan. Okay. That's right. Yeah, that's right. Actually, so what you're saying is what is the difference between a broker and an investment banker, right? Okay. Okay. I mean, if you're going to be very technical about it, it's like a glorified broker. What do you mean by a glorified broker? Broker will provide you, broker will, again, is an arranger who helps two people meet, right? In terms of stockbrokers or insurance brokers or um, what do you call these money brokers, right? They essentially help parties in insurance broking. You will look through the different insurance companies and give the best deal to the client that comes through, right? In terms of the different policies that are available. Same thing investment bank will do, but why they are slightly different is because of the value added activities they add on to it in terms of the valuations, in terms of liaising with like the auditors, the structuring aspect. That's the value addition that they mainly add on to it. So that's why investment banks are slightly defined differently versus brokers, but they are. That's essentially what they do. Does that make sense? I think that's what you asked. Yeah, no, for retail loans, not through investment banks. Now you see a lot more digitalization. With digitalization, you have all these like different um, websites that will come in Sri Lanka. I don't know, like I'm sure there are different startups that are coming up with different like you know of, it's not a startup, but you know of, like for insurance, Insure Me, right, where you go, it's a common platform where you can find different insurance policies. Same way, there are platforms that are there for different loan activities as well in terms of finding it, but still very nascent stages. I wouldn't, there is not nobody that I know of in terms of getting a loan where in Sri Lanka that happens. But it's kind of like what we were talking last time in the securitization about mortgage brokers. Mortgage brokers do the same thing. In the US, we were talking about mortgage brokers and how they were giving out housing loans. So that's the activity that they do for retail investors. I don't know a similar type of agency that operates in Sri Lanka. I'm not positive actually. I'm sure that you would have to get some, because for the banks to work with you, they would have, I don't think, because it's part of their core activities right now, I believe they must be barred from the central bank because they have to, their core activities, they must do by themselves. And all that, yes. Yeah. I'm just saying off the cuff, though. I mean, something for you to analyze and see. But I believe that might have a bit of a legal impediment there. Okay. So let's take the break. It's 10:20. Yeah, 10:15. So 10:35. Okay. So, we come to helping clients raise money through equity and debenture IPOs, right? This is one of the biggest activities investment banks do, and it's one of their more time-consuming activities in terms of trying to help clients raise money through essentially equity raisings, equity and debt, but time-consuming wise, mostly equity raisings. So, what do we mean by companies trying to raise money? Here we talk about the process of an IPO, an initial public offering. Right? This is the first time sale of new or existing securities to the public. Look at the wording here. The first time you sell either new or existing securities to the public. Yeah. So IPOs are not just for shares, it's also for debt. Now, if you saw last week, there was an IPO of debt. Any idea what it was? Last week. Siapatha Finance. That's correct. See, last week, there was an IPO for debt, which was Siapatha Finance debenture, right? So that's an example of a debt IPO. So if you go to the new listings, primary issues, you can see the Siapatha Finance. Now the debenture is over. So this is the first time. Primary meanings, initial issues, right? First time in this case, debentures are being introduced to the public. So you have the prospectus, and we see that Siapatha just did a debenture. And this is the investment bank for the debenture, First Capital. And they raised $4 billion, right? A maximum amount of $4 billion. Initial amount of $2 billion up to a maximum of 4. So what were they doing? They were issuing debentures. They were raising money by issuing debentures. How did they do it? They essentially came out to the market and offered their debentures to the public. This is what we call initial, first time the securities are offered to the public. It's an IPO, right? This is a debenture IPO. And managers to the issue is First Capital. First Capital, the investment bank. Similarly, I mean, this year we still haven't had a IPO for equity. I hear we're getting one soon, but not yet out. So you have debt and equity offerings. The first time it's offered to the public. Now, when we say offered to the public and first time it's offered to the public, doesn't mean that it's brand new shares. It is new or existing securities offered to the public for the first time. That's what we call an IPO, right? Offered to the public for the first time. So when the company wants to raise money, they can either do it through equity or they can do it through debt. Now, what do you mean by raising money through equity? They issue shares. Okay. They offer shares for investors to come and invest in. When they want to do it through debt, what do? They issue debentures for investors to come and invest in, if it's short-term commercial papers or something like that. But in the public space, debentures. Now, why go public? Yeah. Why go public? Why not stay a private company? What are the reasons that you would want to go public? One is obviously to raise new capital, right? I mean, if you're a private company, then your avenues in terms of raising capital are very limited, right? If you want to raise money, how do you raise money? You have to find investors, but investors also want some liquidity most of the time. They want, in case of an emergency, to be able to liquidate their investments. So, as a private company, being in the private space, it's not as easy to raise capital. But if you offer the shares to the public and list it on an organized exchange, slightly easier, right? So, new capital. Access to future capital, because now you're in the public space, people have visibility as to what type of company you are. That makes it easy for you to do even debentures, even commercial paper, because people now, it's a public company that is quoted on the stock exchange, your financials are out there, people have an understanding of who you are, and it makes it easy in terms of future capital generation. For M&A activities, right? Again, people know who you are, and you can use it. Now, for example, when you want to exit even in terms of a private equity investment, you can use IPOs. Some companies obviously don't like to go for IPOs. Some of the reasons being, well, not a very big reason, but IPOs are expensive. IPOs, for example, the cost can be as high as 15 to 25%. Of course, of the amount that you're raising. Right? What is 15 to 25%? 15 to 25% of the amount that you're raising, which is very high cost. So small issues have some fixed cost, which makes it very difficult for the cost to be lower than those values, right? But in Sri Lanka, the costs are not this high. This is typically 15 to 25% is something that you will see in a country like the US, right? Versus in Sri Lanka, IPO costing might be in the range of 5 to 8, maybe maximum 10%, right? That might be where your direct expenses are in terms of your IPOs. What are these direct expenses? The fact that you have to pay the investment bank, you have your initial listing application fees, you do like various events to raise awareness about the company. All of these are direct costs that you will incur when you're doing an IPO. And once you do an IPO and you come to the market, there are many, many responsibilities that you have. If you remember last time in private equity, we spoke about the fact that sometimes top executives don't like being in a public listed company because of the multiple amount of regulatory responsibilities and additional reporting responsibilities that they have. So IPOs, that's certain reasons why some people or some companies don't like to go public. Continuously filing reports with the SEC, continuously filing reports with the CSC, fielding investor calls, investor relations, all of these are big responsibilities that you would have. And there can be loss of control, obviously, because once you come into the public domain, somebody can sell shares and you might, depending on how the shares are acquired, there can be loss of control. So these are reasons why some owners might choose not to go public. So if you do choose to go public, there are 3 ways of doing it, right? The third way really is not a way of raising money. The first 2 ways are ways of raising money and offering the shares to the public. Offer for subscription, offer for sale, and introduction. These are the 3 main methods that the company can choose to go public. Remember, these are true. Most of these factors are true for bond IPOs, meaning debentures. But I will be talking in the context of equity. Most of it, I will be talking in the context of equity, right? What do you mean by an offer for subscription? Offer for subscription is where you invite the public to subscribe for new shares of the company. New shares of the company. It can have what does that mean? The company, excuse me, can be a situation where, for example, the company right now has, let's say, 10 million shares. Each share is worth 100 rupees. Okay. And the company wants to issue new shares. And these shares, these 10 million shares, it doesn't matter how much it's worth even, are held by certain owners. Let's say the main owner of the shares has 5 million shares, and then you have 3 other owners, 2 other owners that hold the rest of the 5 million shares. Okay, so the company has 10 million shares. So you can see this guy is a 50% owner of the company. These two, let's say this guy has 2 million and this guy has 3 million. So this is a 40% owner of the company, and this is a sorry, can't happen. 20% owner of the company and 30% owner of the company. Okay. Now you do an IPO and you issue new shares, right? When you issue new shares, what are you doing? You're essentially saying, okay, you're offering this to the public. So you issue brand new shares, let's say another 10 million, right? This won't be as high. Usually it will be 2 million. Just to make my example easy, I'm issuing 10 million new shares. Now in total, this company has 20 million shares. These 10 million new shares that you issued, you offer it to the public. Come through an IPO and say, I have 10 million new shares that I'm offering to you to come and invest with my company at 10 rupees a share, for example. Yeah. So what will happen now, once this goes to the public, A will become a 25% owner because now you have 20 million shares in the market. B will become a 10% owner. C will become a 15% owner. And the new public, overall, multiple different investors will have a total of another 50% ownership in my example. Right? Typically, companies will raise about 20% new shares, 10 to 20%. There are certain limits on that as well. Not upper limits, lower limits. But this is something that can happen. Now, this new shares, issuing of new shares is what we call an offer for subscription. In an offer for sale, you don't issue new shares. What you do is you sell your existing shares to the public. Let's say, for example, from the first example that we took, in an offer for sale, you will have the same 5 million shares, 2 million shares, and this 3 million, let's say C now wants to sell off his shares. So 3 million shares he offers to the public. Okay. So now what will happen? You still have 10 million shares, 50% ownership by A, 20% ownership by B, 30% ownership with the public. C is no longer there, right? C has decided to sell off his share. This is what we call an offer for sale. Now, what the number of total shares inside the company in an offer for sale has not changed. In an offer subscription, it has increased. What is the main difference now between this offer for sale and offer for subscription? When you look at these two examples, what is happening here? Who gets the money? In an offer for sale, who raises money? Yes. In an offer for sale, yes. C is raising money. Right? Raising in the sense he is getting the money. So he is the person who wants to sell off his shares and he sells it out and he receives the money. The company gets nothing. Although the company is doing the share offer, not C, it comes out as an offer for sale and C is the one who receives the money. The shares are offered to the public. It is listed on the exchange, but money comes to C. typically this would be, for example, in an IPO, in a private equity transaction, when one of the shareholders, private equity shareholders, want to get out. It's an exit strategy, right? Where in this exit, C would offer the shares to the public. Now they've stayed through the company has grown and they want to exit. They'll offer the shares to the public, and after that, A will still be a shareholder. He was the original shareholder of the company. So was B. C was the private equity guy. He took his money. He exited the company. And now the shares are with the public. That's an example of how an offer for sale might work. In an offer for subscription, the company gets the money. The company is raising new funds, right? So some people say offer for sale is not an IPO. That's not correct. Offer for sale is an IPO. IPO is a initial first time your shares are offered to the public. Whether it's new shares or existing shares doesn't matter. It's the first time your shares are offered to the public, right? So therefore, offer subscription, offer for sale are both IPOs. In a offer for subscription, what happens? New shares are issued in the company and offered to the public. It doesn't belong to any of the existing shareholders. And when it's offered to the public gives money which belongs now to the company. So the company can utilize this money to do their projects, whatever they wanted to raise the money for. Versus here, in the offer for sale, you can see when the public gives money, it belongs to C, not the company. And C can then take their money and go off. Okay. Any questions on offer for subscription versus offer for sale? In offer for sale, are SEC requirements required to be met? Yes, it's still required to be met because ultimately you're selling the shares to the public. So it is available for, you're trying to safeguard the interest of the investors. So all the requirements in terms of disclosure, everything has to be met. The third one, introduction, is slightly different, right? Here there is contention on whether this is truly an IPO. Here, all that is happening is you're taking the securities and you're listing it in the stock exchange. So you have the three same parties that I had earlier, A, B, and C, who had 5 million shares, 2 million shares, and 3 million shares. So A was 50% owner, B was 20% owner, and C was 30% owner of the company. All now they will do is they will go to the SEC, and stock exchange, and they will get approval to list the shares in the stock exchange. And there are certain minimum things that you have to, I don't think you can do it with 3 shareholders. You have to have a minimum shareholder. There are certain things that need to be there. But they take it and they list it, right? That's it. They don't offer the shares to the public, but now by the virtue of it being listed on the Colombo Stock Exchange, if somebody wants to sell out of any of these 3 parties in my example, they can just at that point decide whether to sell or not. But here the company is not raising any money. All you're doing is providing existing shareholders liquidity to trade the shares. Questions on introduction? Okay. Yes, it is. It is. Only thing is you're not offering the shares to the public, but you are making it available for the public to buy. So that's the only contention that you can have. It is still an IPO, but you have much less regulatory requirements because you're not offering it to the public to buy. You're simply listing the existing shares. Your disclosure requirements, all of those remain the same, but you don't have as many steps or hurdles to go through because there's no money that you're requesting from the public when you offer these shares to them. You don't offer it. You simply list it. So, yeah, sorry.
Offer for subscription, only like A and B would gain because they will dilute their shares, but they will only gain because the company value will go up.
A, B, and C in offer for subscription or offer for sale.
No, offer for subscription. Sorry, yeah, A, B, and C. Yeah.
A, B, and C we can gain depending, right? It's I mean, when you're in the public domain, your share prices can go up, can come down. You're trying to typically, but here ABC will now be a part of a more because you're more visible, right? So versus a company that was unlisted, you're now owners of a company that is listed, which carries a different weight, a different responsibility, and a different perception in the eyes of the public as well. So you're owners of a company that's listed, and yes, share prices can go up. And why would they list it in the first place and raise money? That is because the company needs money to grow and expand. So this is one way of raising that money. So why have I had put dialogue here? Dialogue actually is a very old IPO, right? It was done in 2005. Okay. Why do I put Dialogue IPO here? Because it is still at this point in time the largest IPO in Sri Lanka. So you can see here, Dialogue did an offer for subscription and an offer for sale. Okay. So they have an offer for subscription. They have an offer for sale. It doesn't state, no? They have an offer for sale. Now here you can see offer for subscription of 290 million shares and an offer for sale of 422 million shares, right? So it was not offered at 1 rupee each, but in 2005, those days, there used to be this concept of what we call par value per share. So the par value of the share was 1 rupee. That was taken out later on. So that don't worry about that 1 rupee thing, right? So they raised 8 billion. 8 billion, and this is to date still the largest IPO in Sri Lanka. They're waiting for the next largest IPO to come through, right? So let's look at a couple of more examples. Recently. So the Cal Optimum Fund, this is a closed-end fund. If you remember, we spoke about this sometime back when we were doing mutual funds, and we said that this is a closed-end fund. It was an introduction. CSC has approved in principle the application submitted by Cal to list the units of the fund. So accordingly, 193 million units will be listed. So they didn't raise money when they did this fund. They didn't raise money at the point of coming and listing. Okay. The actual IPO of raising money they did it without listing. They did it on a private basis, the offer, because it was a private fund at that time. And then only they came and so an IPO doesn't necessarily have to lead to listing. That's also something to understand, right? It's the initial first time your securities are offered to the public, initial public offering. Not feeling well today, sorry about that. So sometime back, But I think this is also an offer for sale. This is what I was showing you last week with the private equity. And you saw Jet and Pan Asian Power, and they were two exits that were there in the private equity space that I had two articles. So Jet, initial public offering of Jet, initial public offering of 82 million shares at 27 rupees through the combination of an offer for subscription and an offer for sale. Yeah.
Why would two investment banks get together for a thing like this? I mean, a single investment bank can easily do it, right?
Yeah. So Ken, if you look at actually, it depends on the different types of. So you see it. Sometimes it's the way that it's pitched, right? So sometimes the large IPOs, several investment banks would work together in terms of different investment banks having different strengths with different types of investors. Valuation capabilities might be different, placement capabilities might be different. So the company's relationships with the investment bank would be another reason why there would be two investment banks. Typically, in Sri Lanka, you'll see that one investment bank or two investment banks will work together. If you look at, I'll just show you in a minute after this, but in the US, you sometimes see multiple investment banks. You'll have the lead investment bank who does the valuation and the structuring or whatever, but then you'll have a lot more placement agents that are there. So you can see here, offer for sale of shares by Emerald Sri Lanka Fund 1. So Emerald Sri Lanka Fund 1 was the one who was selling. So this was the private equity investment exit that was happening in this issue. Look at that. You can see here the total cost of the offering is 58 million, which translates to 3% of the offer size, right? So the cost of the offering is also available for people to see in terms of how much total offering is going to be. So this offer in total raised much. It was a 2.2 billion issue, okay, which is why 58 million is not much when you look at the size of the issue. 58 million for a 1 billion or a 500 million issue would be a much higher expense. So, like this, you can see here, Google, you have this joint book running managers. These are the two main investment banks that were working together on the Google IPO. Morgan Stanley, Credit Suisse, First Boston. But then you have all of these placement agents, which are also investment banks like Goldman Sachs, Lehman Brothers, JP Morgan. Lehman Brothers is no longer there. Some of these investment banks are no longer there, working as placement agents for the issue because of the size of the issue. So in Sri Lanka, it will be typically one or two investment banks working together. But you can see in countries like the US, it can even be more. Sorry, give me a minute, please. Excuse me, please. I'll be back. Sorry about that. Okay, so here again, there is a same thing. I've used the same IPO just as an example. Google IPO also came around the same time as the Dialog IPO in those days, nothing to do with each other, but just using the same example. You can see here, Google also was an offer for subscription and an offer for sale, right? And here you can see Google offered their shares at $85 a share. And it says here, price to the public, $85. Underwriting discounts, $2.38 per share. Proceeds to Google, 82.61, and proceeds to selling shareholders, 82.6. Excuse me. What does this mean? What does this mean? Yeah. Can somebody decipher this statement? What does that mean?
It's a combination of a subscription and a sale. Huh?
Yes. And proceeds to Google mean what part?
Of a subscription.
Offer for subscription, yes. Offer for subscription, the company is raising money. So proceeds to Google means the offer for subscription part. And this is the offer for sale part because some of their shareholders, the existing shareholders, like the private equity, like the venture capital investors that were there, a few of them were getting out. So that's the offer for sale part. And what does this underwriting discounts and commission mean? Correct. The gap between the share price, that is the actual price that's offered to the public, and the price that is raised by the company or the selling shareholder. What is that? That is like if you have a firm commitment underwriting, you will see here that the investment bank might be buying, if it's a firm commitment underwriting, the investment bank might be buying it at 82.61 from the company and the shareholder, and they're selling it to the public at 85. So in a firm commitment underwriting where you have fund-based financing, that is the underwriting discount or the commissions that are there. So that depends. Even if it's not, this is the fee then. If it's not a firm commitment underwriting, then we call it a best efforts. We'll come to that in a minute. Best efforts underwriting, then it is the fee that is charged by the investment bank. So from this, you can calculate how much money Google raised, how much money this IPO raised, and how much money Google raised. How much money did this IPO raise? $1.66 billion, right? Of this $1.66 billion, $46 million went to the investment bankers, either as fees or as underwriting discounts, right? Where they purchased it and fund-based, they sold it to the public. 1.16 went to Google, and 451 million went to the selling shareholder. So you can see the addition of these two do not make 1.66. 1.16 plus 451 does not make 1.66. That gap is the commissions or fees charged by the investment bank. So here again, you see Morgan Stanley, Credit Suisse, First Boston, and then the other investment banks that are participating. So this is 2004. So if you look at like the process of investment bank, how in the IPO process, some of the bigger things that would happen. The first step is selecting an investment bank, right? Once you select the investment bank, all of these processes, the investment bank will do pretty much with the company. Company is involved in every step, but pretty much the investment bank will do. So the most important part of the process, or the first part of the process, is to select the investment bank. Now, in Sri Lanka, corporate finance advisor; in the US, underwriter. In Sri Lanka, actually, underwriting is licensed separately by the SEC. So you can go to sec.gov and they have their who we regulate, and from that you can check out the licensed investment banks and the licensed underwriters. This is as at April, the licensed underwriters. These are the people these are the companies or the banks in this case that can underwrite an issue. So here it's not about raising funds. Here it is typically about what we spoke about when we talked about underwriting, where if the issue is undersubscribed, these are the parties that can guarantee the rest of the money in case there is an undersubscription, right? Now, here in terms of the selected investment banks in Sri Lanka, I've listed down a few, not all the investment banks that are there. I've listed out a few investment banks that are there. And some of them I have just marked them out. Then I put them into two columns. And two of them I've colored in blue. Any particular reasons for these? What are the things that you see? So what I have marked out by the cross are essentially the people who have got the corporate finance advisor license, right? So these are right now the 6 investment banks that have gotten the corporate finance license by the SEC. Right now, SEC is not mandating. I mean, I think they have said they are mandating it, but they are not, as far as I can observe. I'm not really, we are not really seeing that anything else is done to it because there is time to comply, right? And so there is, otherwise, to be able to do fundraising activity on behalf of a company, you need to be licensed by the SEC as a corporate finance advisor. So who I have highlighted and I have crossed is essentially those crosses belong to the companies that right now that have got SEC a license, right, as a corporate finance advisor. What is the two sides of the table? You can see a pattern there. Two sides of the table. What's the pattern?
Banks versus non-banks.
Yes. So these are investment banks which are divisions of banks, actually. Right? These are essentially divisions of banks. So Bank of Ceylon has an investment banking division. People's Bank has an investment banking division. Like this, most you have investment banking divisions within banks, right? Who provide the same services, who help institutional clients raise money outside of their bank, with their bank as well, and outside even. And then here you can't say non-bank, but these are more. These are separate entities. Let's not say independent. That's also not correct. These are separate entities, right? And of this, I've again shown in blue Equity and NDB Investment Bank. Any particular reason?
Equity. Equity is between HNB and I think commercial bank or something.
DFCC.
DFCC.
And
Yeah.
NDB Investment Bank is with NDB. Yes. So they are also bank, but they are subsidiaries. They are not divisions of banks. They are subsidiaries, separately managed companies, part of a banking group, right? These are independently managed companies. Okay. So you have banks versus non-banks, within banks divisions, and subsidiary companies of different investment banks, how investment banks operate in Sri Lanka, right? And when you're thinking of looking at an investment bank, typically the things that you should think about, what is the investment bank I should choose to do my IPO, right? What are the qualifications that they should have? Obviously, you look at the reputation of the investment bank because this is a big deal in terms of being able to convince the larger investors to come and invest with you, right? If you go with an investment bank without a good reputation, they won't have access to the larger investors, the larger fund managers, pension fund managers, EPF, all of these different large investors that you have, institutional investors that you have. If you don't have investment banks with good reputation, they might not have access to those investors. They might still be able to access retail investors, but not so much access to the larger, more sophisticated clientele, right? So reputation is one big thing, because your investors must be able to trust the valuation you're being shown. The investor is being shown. So for that, they will work with an investment bank, or they will believe in investment bank whose reputation is good. The quality of research must be good. Industry expertise, in terms of how much industry expertise they have, what are the types of, what are the IPOs that they have done in the past, how much money have they raised. These are all things that you should be considering, right? What is their breadth and depth in terms of industry expertise? Their distribution capability, right? Who are the investors they have access to? So, I mean, for small IPOs, you see that you don't need the types of investors that you need are not so much. If you're going for a small IPO, you can easily place the IPO with retail investors, and that's done, right? You don't even need to approach the institutional investors. Larger the IPO, you need to make sure that your IPO institutional investors will be able to take a bulk of the IPO, because you can't depend that small investors will be able to take the bulk of your IPO, right? So anywhere, that usually we look at a Pareto principle where maybe like 80% of your IPO is being able to be placed with the institutional investors. It doesn't mean that it is guaranteed, but it is able to be placed with the institutional investors. And then you would look at a smaller component that, is still not placed, but can be placed with retail investors, because you don't come with a 5 billion IPO and to the market and offer it just out of the blue and think that anybody will take it. So a lot of the time, the investment banks have to go and talk to the institutional investors, talk to them about the valuations, talk to them with the company, without the company, to convince them to invest in the valuation. So that distribution capability becomes very important, especially, for example, when large IPOs are being done, right? 5 billion, like when the Dialogue IPO was being done at 8 billion. Okay, imagine 8 billion today is not the same as 8 billion in 2005. Okay, because of inflation and all that, 8 billion in 2005 would be a higher raise in terms of who you have to tap and how much money is available with the local market. So if you don't have distribution capabilities with the foreign markets, then that type of IPO you will not be able to do. So those are things that you would have to think about. Prior relationships, I mean, usually you would have worked with the investment bank before in other relationships, right? In terms of maybe mergers and acquisition transactions, in terms of maybe doing portfolio divestitures, all of these, you might be working with this investment banking group. That's also a consideration that you would have. So once you choose the investment bank, the first thing that they will do is they will start doing the valuation of the company. Well, before that they'll look at the due diligence of the company. Okay? Meaning they'll look through the company and try to understand what's happening with this company, what are the things that they should know about this company, because they are the people who are going in front of other investors and talking and promoting this company. And they would ideally need to know everything about this company. Okay. Meaning have confidence to be able to talk about the company like it is their company. So most of the time, if investors fire questions in terms of what is happening, how is this happening, and why did this happen, or something like that, why is this particular anomaly there in the process or in the financial statements, the investment bank should know what's going on. Is there this lawsuit going on with this company? They should be able to answer those questions, because not being able to answer those questions put doubt in the valuation of the company, because they are the ones who are doing the valuation of the company. And it puts doubt in the heads of the investor. Have they done a proper job with the valuation if you don't know enough about the company? So the first thing typically an investment bank should do is to do a good due diligence on the company in terms of getting a thorough understanding of the company, of its assets, of the taxes, other financial information, any litigation, real estate, intellectual property, all of these things. In addition, other things that they will think about or they will advise the company on would be things like, for example, what type of IPO would the company like to do? Should the company do, right? For example, best efforts or firm commitment. In the US, we call this best efforts underwriting and firm commitment underwriting. In Sri Lanka, we simply say best efforts IPO, firm commitment IPO. What does this mean? Best efforts mean, to my best efforts, I will try to sell the IPO. Right? So an investment bank will take on a mandate on a best effort basis. Typically in Sri Lanka, 99.9% of IPOs are best efforts. Right? What that means is there is no additional guarantee in case the IPO, you can't raise the money that you want, that somebody else will buy it, like an underwriter. Because underwriting costs are high and underwriting is expensive. So you will not see a lot of IPOs with underwriters, right? Very few. But firm commitment is more popular in the US. And I think the trend now is, though, best efforts is gaining a little bit more popularity, but over a long period of time, firm commitment was a more popular method in the US versus best efforts. Although you're hearing more and more that this trend is slightly reversing, especially with retailization of IPOs, this whole GameStop and everything that is happening in the US with retailization. You're hearing that best efforts is becoming a little bit more popular. So best efforts IPO is typically the IPO that we see that investment banks will do in Sri Lanka. What does this mean? It simply means that investment bank will say, I will help you raise funds, right? So you want to raise 5 billion of funds. I'll help you raise that money through an IPO. Sorry. I will help you raise that money through an IPO. We'll do the valuation for you. We'll talk to the investors. We'll do the marketing. We'll liaise with the registrars, the regulators, the stock exchange, everybody. But sometimes you might fall short, right? Your IPO can be undersubscribed. So what do you mean by an undersubscribed IPO? IPOs can be undersubscribed, fully subscribed, oversubscribed. An undersubscribed IPO is an IPO where you want to raise 5 billion, but there's not enough interest and you raise less than 5 billion. An IPO that's fully subscribed is you want to raise 5 billion and you get applications exactly for 5 billion. It is fully subscribed. Right? An oversubscribed IPO is you want to raise 5 billion, you get applications for more than 5 billion. Does that mean you're raising 6 billion? Does that mean you're raising 6 billion? In my example, you don't, right? You have to return the additional amount of money back. You only raise 5 billion, but there is more demand for your IPO than what you want. Oversubscribed IPOs is where you see excess demand for the IPO. Fully subscribed IPOs is where you see equilibrium. And undersubscribed IPOs is where you see lower than expected demand for IPO. So this is the risk for the investor, for the issuer, because they want to raise 5 billion. They don't just want money in their hands. They're trying to do a project, right? So with that, they're trying to raise 5 billion. So when you're trying to raise 5 billion and you only raise 4 billion, that means you have a gap, you have a shortfall, which you will have to find another way of funding, right? This leaves the issuer at risk, right? So it's a risky thing. for the issuer, which is why ideally issuers like fully subscribed IPOs. Issuers would want your IPO to be fully subscribed. Issuers don't mind a little bit of, issuer is the company that's raising the money, right? That wants to raise money. They don't mind your IPO being oversubscribed, but issuers typically shouldn't need it to be oversubscribed. Why? Oversubscription kind of implies very high levels of oversubscription, right? Very high levels of oversubscription kind of implies you could have got a better valuation on your IPO. Maybe you mispriced. So oversubscription is okay. Fully subscribed means the pricing was good. You raised exactly what you wanted to raise. On the side of the investment banks, it's a little different. Investment banks would like the IPO to be obviously oversubscribed, right? Because it is their reputation. You can see a lot of the time, investment banks would say we did IPOs, they were 8 times oversubscribed, they were 5 times oversubscribed, 2 times oversubscribed. Yeah. So it's a good thing to be oversubscribed in the hands of the investment bank, because it kind of implies you've sold a really good company where there is a lot of demand for this company. And you've done a good job in marketing this company and creating investor interest to buy this IPO. So for companies, fully subscribed is ideal, oversubscribed is also fine. For investment banks, fully subscribed is okay. Oversubscribed is what they would love, right? Nobody likes being undersubscribed, because for investment banks, it's a failure. They needed to raise 5 billion. They did a lot of marketing, but didn't happen. For the company, they needed to raise 5 billion. Now they have a 1 billion outstanding that they need to raise further money from in some other avenue, right? After spending all these costs to do this IPO and all this time to do this IPO. So nobody likes an undersubscribed situation. Any questions here? Okay. So best efforts underwriting is where you don't guarantee the amount that you will raise, right? So there is a chance that you might be undersubscribed, but investment bank, because of their reputation risk, will do a lot of things to make sure that you are not undersubscribed, meaning they will do that marketing for you and they will do that valuations for you and everything, because it is their reputation online if it gets undersubscribed, right? Firm commitment underwriting has 2 ways that it happens, how it happens in Sri Lanka and how it happens in the US. We spoke about this. So in Sri Lanka, how does firm commitment underwriting happen? You have an underwriter who is separate. Now you saw that there were licensed underwriters. There are licensed underwriters now. After the 2021 SEC Act, we have licensed underwriters in Sri Lanka. And any of these can act, they are separate from the investment banks. They can act as an underwriter to the issue. Right? And if the issuer wants, he can choose to get his issue underwritten. Either the whole issue or 50% of the issue or 25% of the issuer can choose. Why does he choose to get his, if he does, why does he choose to get his issue underwritten? Because he wants to guarantee himself against the issue being undersubscribed. The risk of wanting to raise 5 billion, but only raising 4. If that happens, now the underwriter will fund the rest of the 1 billion. They will give 1 billion to the issue. And therefore, the issuer will be able to raise all the money that he wants to raise. Right? Why might the issuer only, for example, underwrite 50%, let's say in my example, 50% of the issue. Let's assume the issuer decides to underwrite only 50% of the issue. Why might that be?
because he's the investment bank is sure of raising the balance
Yes.
or
Correct. So it might be that it's a big issue, but the investment, it's a 5 billion issue. That's a fairly sizable issue. But the investment bank knows that these commitments are there. So they're fairly certain this much of money can be raised. But you want to have a little bit of a leeway in case you can't raise the other bit. Then you might not need to underwrite the entire issue because underwriting the entire issue is costly. Underwriting costs are expensive. The underwriter to guarantee will charge you a certain commission, right? Sometimes it can be 2%, sometimes it can be 5% of the issue size, of the underwriting size of how much they underwrite. Imagine you're charged 5% on 5 billion. Imagine how much you have to pay upfront for a guarantee. Even 2% on a 5 billion. So that's why you might not underwrite the entire thing. You might underwrite a portion that you're not positive that you will be able to place. So it's sometimes not even about being positive. It's sometimes about relationships, right? So that's how underwriting will work in Sri Lanka. Usually you will look at what is the gap that needs to be filled. And that's how much the underwriter will utilize to fill that gap. In the US, what will happen? The firm commitment underwriting will mean that the company will issue the shares directly to the investment bank's books. And the investment bank, on behalf of the company, will carry out the IPO from their books. So this will happen simultaneously. It's like the company issuing, but the investment bank selling it will sell it from their books, right? So company might issue at 490. Investment bank might sell it at 5. And the entire thing, investment bank, right? This is not 1 billion, investment bank will buy the entire 5 billion to their books. The company is now happy. He's got everything sold. He's raised all the money that he needs to, but he has a cost. There is a cost. And this is how that cost would work. In Sri Lankan underwriting, there would also still be the same type of cost, right? In terms of guarantee cost. So that's firm commitment underwriting. But in firm commitment underwriting, the company always manages to raise the amount of money that they want or need. So to look at example, we don't have a lot of IPOs are not underwritten in Sri Lanka, right? Very few. I only remember one. That's also not very recent. So RIL did their IPO in 2017. So commercial bank and NDB were the main issuers. So underwriting. How much is this IPO for? So RIA was trying to raise 960 billion, right? That was the IPO at 8 rupees a share. They were issuing 120 million shares to raise 960 million, nearly $1 billion, right? So 2017. I mean, their share issue was oversubscribed. They didn't have to utilize the underwriters, but this IPO is one of the few examples that is there of an underwriter. So in the event of an undersubscription of the IPO, RIL would still be able to execute up to 500 million fundraising through underwriting. So it was a 960 million issue. 500 million up to 500 million, they were looking at underwriting the IPO. Okay. So it was not fully underwritten. Cost of the issue, 45.2 million, which is 4.71% of the IPO size. In the case of an undersubscription and full development of shares to the underwriter, the total cost will increase by to 49 million or 5.2% of the issue because of additional underwriting fees. Okay. So the costs include expenses associated with the issue, inclusive of CSC fees, management fees, advisory fees, brokerage, commission, registrar function, legal, consultancy, accountancy, underwriting, advertising, promotional, print, all of these. So that's an example of underwriting. Okay. So they would give advice on, investment banks would give advice on when to come for the IPO, right? Sometimes investment banks would sit on an IPO for 4 or 5 years. Sometimes, because that's in Sri Lanka, right? You don't see investment banks sitting on IPOs for that long in developed markets, but because they want to do the deal and do the transaction and churn it, right? But here, sometimes you see that our markets are so nascent, right? So underdeveloped. If you come at the wrong time, then ultimately your IPO can be undersubscribed. There won't be demand for the IPO. So you have to wait, and there are clear windows, what we call windows of opportunity that open up from time to time. Sometimes the market suddenly becomes very active and everybody is interested and want to invest in the market. Those are the times that you should be timing your IPO for, when there is a lot of excess money coming into the market. And at that time, if you come in with this company who wants to raise money, investors, even if it's not, investors will then really seriously evaluate the company, right? So the stock market conditions, economic conditions, industry conditions, all of these will play a part, and it's for the investment bank because the company is not in the business of financial markets, right? So the company might not know exactly what's happening with the financial markets. Investment bank should be able to advise on what are good times to come and offer it to investors and what are not. Pricing. Pricing is a big component of the investment bank's job. Okay? How much should I offer to the public? How do you figure out how much to offer for this company? The company has an idea, they want to raise 5 billion rupees, right? So to raise 5 billion rupees, how much and what percentage of the company should be offered to the public? That's something to be thought about. You have to first do a valuation of the company to figure out, okay, what are the prices that what is the value, not prices, what is the value this company is worth? So investment bank will sit down with the company in terms of, and they will do the valuation. Investment bank will do the valuation, usually discounted cash flow valuations, right? You can do relative valuations like peer analysis, or you can do discounted cash flow valuations, dividend cash flow valuations, right? Dividend discount models. You can do these multiple types of valuations. And based on the valuation, or based on the range of the valuation, you can come up with how much is this company really worth. First, you have to figure that out. Okay. If this company is worth 10 billion and the company wants to raise 5 billion, maybe not, IPO is not the way to go. That means you have to give up 50%. You have to offer to the public nearly 50% of the company. Company is worth 10 billion, right? So if you want to do an IPO for 5 billion, that's a huge component. Are the shareholders wanting to dilute that much? So then investment bank might want to give advice that maybe let's look at some debt and equity combination. Let's only do an IPO for a lower amount because you will have to dilute yourself a lot, right? So the first thing that the investment bank will do is, one of the first things will be after the due diligence to do a valuation of the company. Once that valuation is done, they'll try to figure out, based on the valuation, what is this company worth? How much money does the company want to raise? How can we do it? What is the price that investors should be offered? So why is that important? Because have you seen IPOs which are priced at 100 rupees? Are investors asked to come and invest in, if you're like in the stock market, have you seen IPOs ever? Let's say IPO price is 100 rupees. Maybe sometime back, very long ago, not in the recent past, right? Most of the time you see that IPOs are priced at 10 rupees, 8 rupees, 12 rupees, 13 rupees. These are the prices that come out for IPOs. Why is that? These are little magic numbers, right? That investors like to see. 10 rupee share. It's an 8 rupee share. It looks cheap. It's just mentality wise, it looks cheap, right? So if your company is worth 10 billion and let's say your company is worth 100 billion, which is putting raw numbers here, right? And you have 5 billion shares, 5 billion shares, that means each share is worth 20 rupees, right? Or let's say you have 1 billion shares. That's better. So you have 1 billion shares, that means each share is worth 100 rupees. Now that means if you look at you should technically, my company is worth 100 billion. I have 1 billion shares. I should be offering it to investors at 100 rupees. So investment bank has done this valuation. I know how much the company is worth. But if I go to the investors and offer my shares at 100 rupees, investors will say this share is so expensive. It's not really. It's correct valuation, right? Company is worth 100 billion. Company has 1 billion shares. So the share is worth 100. But investors will look at this 100 number and they might say it's not good enough, right? I mean, it's expensive, but it's really not. Maybe it's cheap. So you have to bring it to a level where investors like to deal with. So you might do a share split. Split these shares to 10 billion, do a 1 to 10 share split, and bring the share price down to 10 rupees, for example. Now you offer it to investors, company still worth 100 billion. Now you have 10 billion shares at 10 rupees each. You offer it to investors will say it's so cheap. So you have to play with the investor's psychology while looking at or maintaining the integrity of the valuation, right? So these are different things that investment banks can give you advice on. What is the price? What is this company actually worth? What is the price that you should go to the market at? How much should you dilute? Because you want to raise 5 billion out of a 100 billion company, fine. You're only diluting this much, right? But if you're a 10 billion company, can you afford to dilute that much? Then maybe we should look at other alternative ways of doing it. Okay. So these are different things that you would be thinking about. Or investment bank will be thinking about and advising you on. Now, usually, you know that price, you know that pricing wise, what will happen? Usually you have a single price mechanism, right? So we have a single price mechanism where we say this IPO is worth 16 rupees. So I'm offering you these shares at 16 rupees a share for a total value of 3.2 billion. If we look at the last IPO that I think it was the Kyrgyz Bank IPO. Was that the last IPO that was there?
Yeah.
So Kyrgyz Bank. Thanks. Kyrgyz Bank IPO. which was done last December, they came up with, so there the investment banks are CT, CLSA, and NDB Investment Bank, 62.5 million shares at 8 rupees per share. Okay, this is offer for subscription. You can see it's offer for subscription. Cost of the issue 31 million, 6.34% of the issue size.
Oh, we cannot see the screen. Yeah.
You can't? Is it? Oh,
No,
sorry.
it's just a blank screen.
Oh no. Sorry. Cost of the issue 6.34 million. So this is Cargill's, which happened last December 14, 2023. This year we haven't had any IPOs, so the investment banks are CBC, NSA, and NDB Investment Bank. Offer for subscription. It's an offer for subscription. Cost of the issue is 31 million, 6.3% of the issue size. And pricing wise, it was offered at 8 rupees per share. So it's a single price mechanism, right? So a lot of the time though, again, if you look at developed countries, they will use what we call a book building process, a book building process. So in a book building process, what you do is you try to offer a range of prices to investors, and you say, or you don't even offer a price to investors. Sometimes you just send a prospectus out without a price in it, and you send the prospectus out, and you call this the book building process, where you try to figure out, you talk to your sophisticated investors to try to figure out what is the price that can be offered, or what is the price that they are interested in bidding for the IPO. So something like this. Okay. You can see here, Uber, we call this sometimes the red herring. In the US, they call it the red herring prospectus, right? The red herring prospectus, because it's prominently highlighted in red, that this prospectus doesn't carry any price, and it is simply there to give information about the company. So this type of prospectus will be sent out to the investors for them to evaluate the company and come back with their interest. So they don't say, the investment bank doesn't say, or the company doesn't say how many shares will be issued, the per share price, the percentage of shares to be issued. All it does is it gives you, when you read through the prospectus, it gives you details about the company. In this case, this was the Uber IPO 2019. After they do this, the big investors, they'll do a book building process with the big investors, where they'll go to the big investors and ask them, you read through the prospectus, what do you think is their interest? Do you want to bid for it? What price would you like to bid for it? Right? They do a book building process. So once you've done the book building process, you come up with the price that most investors like. And then you have a fair idea, if we come at this price, we'll be able to place the IPO, and this much, we'll be able to, there'll be good commitments at this level. So you have a fair idea, and you will make the final decision on the price, and at which point, so this was in April 11, 2019. What is this? May 14th, this is May 14, 2019, the final price has been decided at $45. Yeah. So that's the final prospectus. So that's kind of down here in the Google IPO, you can see expected price range $108 to $135 per share. Here they've given a price range to the investors and said you can bid Depending on the price that you want to, you can bid where you think it's worth. And based on that, investors will bid. And obviously Google will start raising money from the highest point onwards. This method is called a Dutch auction method, right? So what I showed you before was a book building process. And this method of giving a price range or even through book building, uh, asking people to quote for prices is what we call a Dutch auction process. Dutch auction, where, like, for example, our treasury bill auctions are kind of like a Dutch auction process where they ask people to quote for prices. Okay. So in that process, now in Sri Lanka, we've had this Dutch auction process or book building process some time back. When the Dialogue IPO was done, it was Lanka IOC was the very first IPO to go through a book building process, and then Dialogue and a few IPOs were done during that time. And after that, interest in that died down, and we went back to single pricing methods, right? But you would see that book building is a method that's used in developed markets a lot to make sure that there is good demand for the IPO. Now, if you look at, for example, how a Dutch auction process or a book building process works, this is the Dialogue IPO. So Dialogue offered its investors 5 different price points, 8, 9, 10, 11, 12 rupees. They said you can choose to apply at any one of these prices. Now, in Sri Lanka, most of these Dutch auction process offered, essentially told investors what prices they can apply at, but they gave options. You can see in the Uber IPO and you can see in the Google IPO, it was either a range or no price, where the investor chose the price to input, right? So usually the book building process, you would come up with the range and then you would offer the range. But then after that, within the range, any price is acceptable. But here, without complicating so much for investors, 5 prices were offered. So what would happen in this type of IPO, or what happened in, for example, the Dialogue IPO? So these prices that were offered were 12 rupees, 11 rupees, 9 rupees, 10 rupees, 9 rupees, 11 rupees, right? And Dialogue was trying to raise 8 billion. And 8 billion, I think they came out at 12 rupees a share or something like that. And they said, anybody interested? Apply at whatever price you want to. So they didn't come out at 12 rupees a share. It was ultimately decided through the process. So you want to raise 12 billion. How would this process happen? Investors send in their application and they say, I want to buy Dialogue at 12 rupees a share and I'm willing to invest 1,000 shares. Some investors will say, I want to buy at 12 rupees a share. I want to invest 1 million shares, 10 million shares, like this, right? So through this process, let's say there was investor demand interest for about 7 billion shares at 12 rupees. 7 billion worth shares at 12 rupees, right? How much did this say? It doesn't say, no? So 8, 9, 10, 11, 12. This is just like a treasury bill auction. So up to 7 billion worth of shares at 12 rupees, there was interest, right? And then, so Dialogue wants to raise 8 billion. That means the entire interest is not satisfied. Okay. So then what would happen? Dialogue will say, okay, I want to raise 8 billion rupees. 7 billion has been subscribed at 12 rupees, but not enough interest. And then he'll look at the next level. Okay, 6 billion applications have come at 10 rupees. Let's say 1 billion worth applications at 8 rupees, another 1 billion at 9 rupees, 5 billion applications at 10 rupees, right? This is how the applications have come. So you look at it and say, okay, I'm going to raise, because I want to raise money and I want to raise it at the best price possible for me, right? So what is the best price possible? 12 rupees. For every share that is being subscribed, if I can get 12 rupees per share, Dialog would be happy, right? The issuer would be happy. So they would start taking it from the highest price. They would start raising money from the highest price. Unlike government securities, they're borrowing. Here, Dialog is getting money. People are investing with them. So they'll take the people who are willing to pay the most for their investments, right? So they'll start at 12 rupees and then they look at the next level. Okay, I only want to raise 8 billion. My need is fulfilled. I have completed my 8 billion now, right? And then all these guys get rejected. Everybody who asks for shares at 10 rupees gets rejected. Shares at 9 rupees gets rejected. Shares at 8 rupees gets rejected, right? They get rejected, and only the people who ask for shares at 11 rupees and 12 rupees, which is the cutoff point, is accepted. That's the first step. Then, out of these accepted shares, you can see that Dialog can only raise, they have told the SEC they want to raise 8 billion. So, of that 8 billion, 7 billion has been, people are willing to invest at 12 rupees, and 6 billion was shares they're willing to invest at 11 rupees. So 11 rupees is the cutoff point. I hope you understand that. That is the cutoff point. So then what would happen? Dialog would accept all shares in Sri Lanka. This was how the book building worked in Sri Lanka. All shares were accepted at 11 rupees. 11 rupees. All shares, right? Remember, that's like the US, a single price system. Now, for treasuries in Sri Lanka, we use a multiple price system, remember? But for the share market, we used a single price system. And here in the single price system, everybody was accepted at 11 rupees, meaning people who bid at 12 rupees and sent checks at 12 rupees a share got a 1 rupee refund. Right? 1 rupees was sent back to them. And Dialog accepted all the money at 11 rupees each for both. Now, everybody who bid at 12 rupees a share got their full allocation. But if you bid at 11 rupees a share, now Dialog has already raised 7 billion. They only need 1 billion more. So that 1 billion out of 6 billion gets prorated among the people who bid at 11 rupees a share. So that's how in Sri Lanka, your book building Dutch auction process worked. Actually, in the Dialog case, everybody, you had applications at all these levels, but Dialog got applications for this IPO, if I remember correctly, something like 56 billion or 54 billion, right? So they got 56 billion or 54 billion worth of applications of 8 billion. So they raised all the money at 12 rupees a share. So Dialog IPO raised everything at 12 rupees a share. They rejected all applications that came below that 12 billion. So that's our time. Any questions before we stop for the day? Okay. So we'll continue next week. Yeah, go ahead. Okay. Yeah, it is a publishing mistake. I have given that in your assignment, in the data file. It's clearly mentioned that there is a mistake in the way they publish the prices. So to take it the other way around, it's mentioned in your data file. Your assignment, thank you for bringing that up. I would have forgotten. Your assignment is due this week, right? So every group must submit the assignment. Okay. Even if you made no changes in your assignment through the past 10 weeks, your assignment needs to be updated to the new prices only. If you made no changes, it needs to be updated at least to the new prices and resubmitted, meaning you have your first portfolio and you have your week 10 portfolio. So for a group that did nothing between the 10 weeks, you have the first portfolio and the same shares must be there in the last portfolio, but marked to market. Okay. So if all the other groups that did their assignment and they submitted multiple portfolios throughout the 10 weeks, the final week's portfolio should be marked to market and updated, and all groups must submit the week 10 portfolio. Okay. All groups. Okay, thank you. I'm here for questions. Thank you.